Mic check, mic check. This meeting is live. If there's anyone watching, please let me know if I'm coming across clearly. Mic check. Just doing a quick mic check. Sorry for the 2-minute delay or the 3 minutes delay. Can anyone hear me? Then we start. It's gonna be an interesting war room today. A very one, because I want to kill two birds with one stone. Clear. Thank you so much. Thank you so much, Mr. Kakoma. Fantastic. Then we start. Then we start. Good evening, everybody. Those of you who are currently watching, those of you who will watch later. Let's rock and roll, man. I hope we're all doing well. So I'm gonna do a couple of things tonight. Just to be very clear, I've got a trader's war room that I need to get through. So I need to talk to you guys about a couple of signals, a couple of entries, a couple of trades that we want to take, that we want to add, right, to our captains, no, well, not captains program, to the actual challenge, the actual 365 challenge, right? So that's the main thing that we're going to do tonight. But at the back of all of that, we are also going to be talking about the next class that we're supposed to have. So tonight, I will be teaching through the war rooms on one of my favorite tools that I use to get confirmation entries, right? Why I was able to get that 147 pips on EURUSD sell-off on Friday. That was a very big trade, which we gave out in a war room exactly like this. If you just go through our YouTube channel, you'll be able to see it. So that's kind of like the two things we're going to do. Naturally, because there's an element of teaching involved, I am not extremely sure how far I'll get. All right, so in terms of how many assets I'll cover, I've got a long list of assets to cover. If I don't cover them, obviously I'll do a pre-recorded second war room tomorrow, and I'll just upload that as a supplementary dose. But this is really what I want us to focus on tonight. So there's a lot of pound pairs, AUD pairs, NZD pairs, Euro pairs, palladium, gold, silver, platinum, and cotton that we need to do. And then we need to get into phase 3, which are the company indices. Now, I can tell you right now, I will not be able to do all of that tonight unless if people want to stop the war room at about midnight, right? Because it's going to take a lot of time to kind of like focus on these assets. And because I'm teaching tonight, it's actually going to slow down the process as well. But what I'm hoping that you get is an understanding of how I use my favorite tool. Shake my hand, Alan, shake my hand, everybody. Good. What's wrong with me? I'm starting to forget the shake my hand. Hope you guys are doing well. Good to see all of you. Right, so it's absolutely critical that you follow. If you've got any questions, I'm gonna pop the chat on screen 1 on my left here, and I'll be kind of like looking at the questions, you know, as I go. But if that's okay, let's start. Right, so for tonight's class, and when I say class, there are some of you who are currently doing module 2, the live classes. You know exactly what I mean by class, right? We are in our second last week of class, or could be our last week potentially. Just depends on how far we go tonight and how far we go Tuesday, Wednesday, Thursday. All right, we've covered supply and demand. We've covered every single thing that we need to know in terms of what I'm looking at. Eunice, good to see you, ma'am. Good to see you. And essentially what I want to do tonight then is to give you my favorite tool. The Fibonacci is a tool that I generally will not trade without, right? If I'm not taking valid demands and peak supplies, so Fibonacci won't work on valid demands and peak supplies. We spoke about these two last week, right? So inside our Trader's Edge, right? And in case you're new and you don't know what I'm talking about, I'm simply referring to the 365 Traders course. If I can just show this to you quickly so that we're all absolutely on the same page, right? So this is, if you're to join the academy, description will be down in the link below. After this live stream is done, you will get access to this folder. This is our full 365 course, all my lecturing stuff. I don't want to spend time going through this. It's an 8-week course when taught live. It takes about 2 months to get through. You get all the lecture videos up front. It's Black Friday month, so everything in this entire folder, this is module 2, the one that we're currently dealing with right now in our live classes. All of this stuff with weekly PDFs is just $100. Literally, it's a dead giveaway. Take it if you want it. If you don't want it, also cool. And once you enter the remote course, you get free access to module 3 when it drops. And tomorrow I'll be sending out a report so you guys can finally see the type of back testing I'm doing. The results are quite impressive, right? And then for 16,312 challenge, you will note that some of the trades we're already currently engaged in. Some of them are still waiting for them to be triggered. You will get access to all my trade signals, my trade setups, the format on how to grow a small account, the trading setups, the explanations, all that stuff is packed in the remote course, right? So when I say there are some people on here tonight who are actually focused on the classes, those are the people I'm talking about. They're either remote classes or here. Jay here, good to see you, Jay. Right, so I want to talk to you guys as quickly as possible about a couple of things, and I really hope, God willing, we can cover as many of them as possible. Right, now, we will do a war room. Please note, I'm about to do a war room, but just to remind everyone of where we are. And I know today we started 30 minutes early, so I'm hoping we can make some good time and cover a lot of ground with this. Your toolkit is based on the stuff that you've done with me so far. Please, guys, do not break this bond with your toolkit. Right, in module 1, which was the first month of September, when we met in the whole month of September in module 1, this is your take home. Because when it comes to the Fibonacci is a sneaky way of combining a lot of things, right? So what the Fibonacci does is it answers questions like this. What do you do when there are 3 areas of value on one leg, right? So which supply would you choose? Let's say prices left a demand, there's a demand down there, and price is currently leaving a supply, right? So markets are coming down, right? So the purple is a supply, right? And then as price starts to come down, it does this, and then it comes down, and it does this. And then all of a sudden, before it reaches your demand, markets start to retrace. Retrace meaning to go back, because we remember we're 365 traders. We understand price movement. We know that if markets leave a supply, markets must equally go meet a demand. So we can hold our trades. For swing traders, that information is predominantly the most important. Where is price going? Weirdly enough, guys, in trading psychology, we are going to think the exact opposite. But I'll teach you that stuff, as time goes in this channel this year. That's why I said I am not taking another live class for the rest of the year. After these guys are done this week, we're going to go jump straight into trading psychology on the channel. We cannot wait for 3,000 subscribers. That is punishing, a lot of students that have been with me for at least a year now, who've been waiting for a trading psychology model, right? So that's just going to start airing out on the YouTube channel. But between this supply here and this demand all the way down there, and markets start to retrace, which supply are you going to choose? How do you know where to re-enter? How do you know when to move your stop loss to break even or to lock profits? Which zones are you targeting? I use the Fib tool. And so tonight I want to cover a bit of that, but as we cover it, we're going to be mirroring the Fib tool on a lot of war room trade calls that we're about to make, moving forward, right? Damien, good to see you, brother. Good to see you. We've got Botswana, South Africa, Zambia, and Kenya in the house there on the live stream, right? So that's absolutely important. I'm not watching the private Telegram group. So I'm hoping that no one is confused. I'm hoping none of the students are confused. If anyone has time to keep a track of that Telegram, we just direct people to our YouTube channel, right? So this is what I want us to look at tonight, right? So Fibonacci is extremely important, but it requires a trader who understands the basics. So the basics are this toolkit that we've built over time together. Number 1, we spoke about major turning points. The first type of supply and demand I've taught you in the course. If you've done the course, if you have access to the remote course, major turning points allow us to do what? To start to profile the assets. Very important, because you need to understand the profile of the asset if you're going to be able to adapt a Fibonacci in the right direction. All right, and some of this stuff doesn't apply on the smaller time frames, but on the bigger time frames, I guarantee you it matters, right? So after we started to talk about profiling, we looked at our areas of value, and I'm not going to write all of them down. There were 5 types of areas of value: original, fresh, retest, glass effect, used up, all those areas of value, and most importantly, the rules that come with it. After that, we looked at supply and demand. Number 2, we called that a 365 candle. The bigger point note is it's a PCP. And in tonight's class, I'll go back to EURUSD. I'll show you how powerful some of these PCPs can be when they're at the right place at the right time, confirmed by Fibonacci. This is the 147 pip trade that we just had this past Friday. All right, so that's it. But if you guys go through the YouTube channel, you'll see that this trade signal was given 2 to 3 weeks ago. All right, so Fibonacci is it's a forecasting tool. It's not an indicator, all right, but I'll explain the whole thing. So after we did PCP 365 candle or supply and demand number 2, 365, I'm rushing because it's just a summary for people who've been in my classes. We looked at complicated 365 candles. After that, we looked at Talitha areas and we code our areas of value. For various reasons, but we all know what I'm referring to here. And finally, supply and demand number 5, which was turning points. So this concluded 4 weeks of teaching, all right? For those of you who are doing the live classes, this is the basics, right? All the rules are in there, the imbalance rule, fresh touch, which areas of value can we use for a retest or just for a fresh touch, the whole works. In module 2, we have come to add, right? We've simply added. Module 2 is different. We're talking about the trader's edge. Trader's edge here, we've looked at a couple of things. Number 1, specific buys that I like to get into, specific sells. And when I say get into, I get into all of them, but if I'm going on a very big lot size, on a big account, or if I'm going on a Hail Mary, if I die, I die, which is a terrible way to trade because you're over risking. So let me put it this way. Areas of value that I trust the most, we spoke about these value-based demands, and we spoke about the formation of value-based demands. It's in that folder, that module 2 folder I just showed you. And then we spoke about peak supplies, which is really my top selling place. And then last week, we concluded the week by looking at engulfing patterns, right? So now we've got one, in terms of areas of value, in terms of types of supplies and demands in the course, we've done 1, 2, 3, 4, 5, 6, 7, 8. We've got 8 supplies and demands that I'm praying to God that everyone fundamentally understands. It's very important you understand this, right? And then we started to talk about tools. The big tool that we've covered so far is a supply and demand curve, which I think was our last class together. In the supply and demand curve, I built the building blocks of how to correctly draw a Fibonacci by referring to market phases. I don't know if you guys remember me referring to this term market phases, but anyways, in general, when I teach this stuff, you'll see in the remote course, I refer to it as a leg, just a leg in the market, right? Understanding that markets move in phases or in legs is the starting point for drawing a Fibonacci, a correctly drawn Fibonacci, right? So this is where we are in our course. And once again, it is indeed a trader's war room. If you're not a 365 student and you're just here for trading signals, just bear with us. We'll be in and out. We'll be talking about a lot of stuff tonight, and I'll walk you through the charts as usual, right? But I just wanted to quickly map this out, right? So this is where we are as a class. This is where we are as a community. And tonight we're going to be focusing on giving out signals for the month of November, give or take. I mean, I'm sure we could narrow it down to this particular week. But we're also going to be looking at fundamentally how we're going to be using the Fibonacci to confirm entries. So I want to quickly build all the rules now on the whiteboard, and then we can spend a lot of time rest of the night on the charts. If there are any questions, I have a screen dedicated to the chart feed. Please feel free to talk to me there. Feel free to ask me there so that I keep track of where you are in your mind, especially if you're here for class. It's very important that we rock together. The first thing you need to know between a Fibonacci is that it can only work on a retracement. Fibonacci is a retracement tool. If the sound gets weird because I'm moving a lot, let me know as well. It's a retracement tool versus reversals. If you draw a Fibonacci on a market reversal, it won't work. So why I've just done the toolkit is for this fundamental reason. Anyone who's mastered the basics and gotten through the course so far would understand what I'm about to teach tonight. It's absolutely important because the wrong idea, or at least the wrong confirmation tool being used, could be the result of a loss, right? If you draw a Fibonacci when markets are reversing, you have a problem. So let's break these two terms down, because markets do three things 9 out of 10 times. The first thing that markets do is markets trend. Markets always trend. In fact, markets trend less than anything else, by the way. So you don't always get trend in markets, right? Markets, generally speaking, will consolidate more times than they will trade or trade sideways. In fact, the Asian session is known for the greater contribution to trading. But even on last week's class, when I broke down Euro USD, I think it was last week, Wednesday night, and we went to the smaller time frames, and I was showing you what I call scenario analysis, which is a big part of module 3. And I was just showing them a couple of tricks. You'll see on the 15 minutes, 1 hour H4 time frames on like Euro USD, we have 3 days of pure consolidation where markets are moving within a block range, and then on day 3 or day 4, markets will explode up or to the downside, right? So generally speaking, there's a lot of consolidating, or what professionally is known as ranging markets. So markets do trend, but they trend less. Most of the time, markets sit, accumulate orders, and then blow up or come down and then accumulate again, right? And then in general, as they trend, they consolidate, there will be multiple reversals, right? So a reversal type of situation, which in itself is a type of a trend. Because then if markets were going up and they reverse to go down, that can be considered a downward trend, etc. All right, so that's just basic stuff. Now, when it comes to a Fibonacci, you must know the stuff from your module 1. Let's say markets are leaving a supply, and by supply, we are talking about an area of value where supply exceeds demand. They are more institutional sellers, right? We're 365, we are supply and demand traders. We use smart money concepts. We are learning how to trade like the banks for effective results. And I think some of you can attest, we've seen it. We've seen it a lot. It works all the time in general. A supply is where we believe banks have multiple unfilled orders. There is a cluster of a lot of sell orders in that particular area waiting to push price down. The orders are unfilled, meaning the money in those areas has not yet been used. We should know this by now. And in the same time, in any particular chart, doesn't matter the time frame, there is always a valid demand. A valid demand would be the opposite. Now, if prices leave in a supply to a demand, which at 365, we believe that's how price operates. And today I sound very basic, guys, because it's a war room, so I don't know who's watching, right? So you forgive me for a module 1 tone, right? There's a demand somewhere down there. Now, if prices leave in a supply, and we believe that for this phase or for this leg to be complete, markets must reach a demand. And all of a sudden, on prices way down, right? You can imagine these are all red candles, right? Red candles going down. I'm just going to use a line just to save time, right? As prices going down, markets stop there. Not just stop. All of a sudden, green candles start to show up, right? And as green candles are showing up, as a trader, you have to make a decision. What's going on? Is it time to close my sell? Is a selling over? As price hit a support or whatever trading style you might be used to, whatever, is the selling over? That's the main question. Because if the selling is not over, according to our analysis, which in general, if this was a governing supply and all things being equal in the world of supply and demand, this is a real supply, markets are coming down from a supply, we know that the target is here. Now, the fact that markets have stopped there, right here, is an indication that price is about to do a retracement. A retracement is not the end of the trending leg of price. A retracement in this example is not the end of selling. A retracement is a market pause. A retracement is better positioning for the banks. A retracement is, geez, we've made a lot of money selling, but logically, if let's say this is Euro USD or Pound USD, right? And let's say we sold at 1,200, right? 1,000, right? And then markets have dropped all the way down up to here. So let's say this particular area is, I just want to use like round numbers so we all don't get confused. Can you guys believe? I mean, Liz from Kenya. I don't know if you're watching, and if you are, I haven't forgotten. You want me to do a comparison between Nike 225 and JPY pairs. I'm halfway through. Interesting data. But the other thing, 365 students who've completed the course, there is I have an assumption that 365 numbers might hold a little bit of truth in currency markets. Now, we use 365 numbers in the indices, which I'll teach the new students very soon this week. But if you've done the full course, there's this weird thing I'm picking up about 365 numbers, or we could create a version of 365 numbers in currencies, which is quite fun to backtest, right? But you'll hear from me by the end of this weekend when I'm done. Together with Liz's video, right? So markets have dropped here. Let's make this a round number. So let's say markets have dropped to 1,800 or something like this. Does that even make sense? No, it does not. So let's make that 18, right? So markets have dropped to 1,18. They were at 1,20, and it's just been a whoop, a big drop, right? Nice drop. We're happy with this particular drop. Fantastic. As markets get here, they turn around. There's a retracement. Why is this automatically a retracement? If your analysis from the basics is correct, you would know that price has not yet arrived at its destination. You remember how we started the course in September? Price always is a starting point and a destination. In trading psychology, you're going to have to learn to balance this out. This is for Leroy, not for the trader in trading psychology. It's a weird trick. For the trader, you must know where price starts and ends. For trading psychology, you must accept that every single trade, doesn't matter, you don't know, is an act of randomness in the market because you're going to trade in clusters. Those two things sound contradictory, but it's a beautiful thing. But if you read Mark Douglas's book, you should be well, completely, well-rounded on that particular topic of trading in clusters and not knowing the future in the markets, right? So I'm just simply saying, from our technical analysis, there's a start here, price even a supply, there's a demand there, price is going down to that demand. Mrs. Mtunzi, good to see you. Lincoln, Mr. Ambassador, good to see you. Right, so all this particular stuff is happening. All of a sudden, markets stop dropping and start retracing. This is an opportunity to pull out a Fibonacci. What you want to know is, all of a sudden, why did price stop falling? And where will falling continue? That's the most important part, because you understand that price should stop falling when it gets to a demand. We don't sell in a demand, we buy in a demand, right? So if this happens, the banks have decided to push price up, let's say to somewhere here, and because we're using, some currency codes just to make it real, let's make this 1,190. So they're going to pump it up again before dropping. Why? Because nobody, especially big institutions, would want to sell low. So if price has been good, making all these profits here, they might want to push price up a little bit to continue going down. The Fibonacci will allow you to identify the correct, most accurate, high probability area of value that the banks are most likely to use. Bearing in mind that our broker, TradeView, whoever we're dealing with, is currently printing orders on a timing lag. That's why indicators are absolutely dangerous. Indicators by design lag by themselves, but the data we're getting is also behind. So you've got a behind indicator on behind data, right? And we fool ourselves to think we're watching this thing. So by the time your order gets filled, you need to be waiting at the right area of value. This is when we need a Fibonacci. We do not use the Fibonacci in a scenario like this, where all of a sudden price has finally arrived at the demand. When markets have arrived at the demand, we expect a reversal to take place. This is a reversal. What that means is it's gonna go green. We are at a demand. We expect to see buys now. None of these buys are downward retracements. This is a complete change of trend, change of money. The order flows in charge are buy order flows. Demand is in charge. We expect price to go up. If we're looking for a demand retracement, it's going to be when price pumps up and then all of a sudden before getting to this supply or any other supply on the chart, markets start to pull back a little bit all the way down. And as markets are pulling back all the way down, we want to ascertain where would be the next place to buy, or rather, where is smart money going to buy again to continue that particular journey. I'm really hoping I'm coming across clear. I'm really hoping I'm coming across clear. I didn't even waste time doing long intros today. So just to quickly hammer this point, this red down here, the candles going down here, this would be the retracement on a bullish trend, right? On a bullish trend. So there are two types of Fibonacci's we can draw. We can go draw a downward Fibonacci. We can draw an upward Fibonacci, right? Hope that comes across. And again, if you're a 365 student, tomorrow when we meet up privately for our classes, for our live classes, please not, I'm happy to revisit some of these things, right? But I just need to make sure that you guys get the gist. This is a downward fib. I can't really draw a good trend line there, but it's fine. I hope that makes sense. I could never draw a bullish Fibonacci when price gets to this supply, because that is now time for a market reversal, right? So that's kind of like a quick intro, right, to what we need to kind of like look into tonight, even though the gist of it will also be war room confirmation trades. Now, here's the important part about this idea of markets moving in phases, or understanding that markets move in legs. For the rest of your life, I want you to be obsessed with what I call anti-Fibonacci. I call her anti because she looks like this. Anytime you draw a Fibonacci, you need to be able to see a pattern like this, right? Or a pattern like this. Anytime you draw a Fibonacci, you need something. You need to look at your charts and then mark this out the way I have. Remember when I was teaching you guys how to draw peak supplies? Peak supplies, you want to see that for a peak supply. Value-based demand, you want to see that for a value-based demand. It's basic patterns. For a Fibonacci, we need two important things. We need the latest, very important, guys. Now I'm building the rules. Latest swing high, and the latest swing low. Right, it's very, very important. Latest swing high, latest swing low. What will be different will be the direction of the fib. Some Fibonacci's will require to draw from top down, and other Fibonacci's require to draw from bottom up, right? And I've done this a couple of times in a few public lectures, but let me explain. Now, let's go back to our example of supply and demand, because that's important. Remember, invariably, you can't take a single trade in your life as a 365 trader unless markets are at a valid demand or a valid supply. Doesn't matter what Forex Profit Guru is saying on the internet, it makes no difference to you. You literally must stick to the rules. You're building a system. Your system will only reward you in as far as you respect it. All right, it's just that simple. Discipline. Right, so let's quickly draw some supply. So prices dropping, prices dropping. What makes a peak supply? Anyone remember? Maybe there's not enough time to even ask rhetorical questions. For me to have a peak supply, I must have the existence of dumb traders. I need retail traders to buy into an area of value where supply exceeds demand. When dumb traders do that, or retail traders, we use the term dumb because that's what they refer to in the market, I get a peak supply. A peak supply is generally where markets will pounce, right? It's where the asking price and the bid price are at a massive disequilibrium, and we can get an imbalance. When we have this, the next thing that we need, if you just remember the example that I've just drawn on the chart, markets are leaving a supply, we expect price to hit this demand, and all of a sudden price doesn't hit the demand. Price stops in the middle of nowhere, right? And then you're like confused. And then fears, the four big killers of trading. The first one is fear. The second one, a fear of losing, fear of leaving money behind, right? So those two fears kick in. Number one is markets turning against me. Should I just close? Should I take little profits and run because I was in a beautiful sell, but all of a sudden price is coming up, right? So that's the first fear. A lot of traders will make an impulsive decision out of that. You are going to make lot of impulsive decisions out of that. You're going to tell yourself it is fundamentally better to exit right now because all of a sudden you can see that markets are turning against you. You're still holding your sell position, but it's getting greener and greener and greener, right? Number two, the second fear is leaving money behind, right? If I don't close and all of a sudden on the third red candle, on the third 4-hour candle, H1 candle, what if markets go back down? I would have missed out on this. Those two conflicting fears are going to plague your mind. And if you've been in the live classes, I've been telling traders a lot about this. Rally-based drop. Yes, sir. Thank you so much. Absolutely. That's a peak supply. Yeah, rally-based drop. Fantastic. Yeah, you got the code in right. Exactly. No. Your pituitary gland, right? That's the part of you that is most active when you're in love. The pituitary gland is the part of you that is most active when you're making love, or when you're scared for your life, when there is a burglar in your house, or you're being chased by a vicious dog. That is the part of our brain we are operating on when we are trading. It is highly sensory induced. So if you're fundamentally inside a trade, a winning trade, I can tell you something. 365 traders, the first thing you learn how to do is to stop losing a lot of the times, because I teach you market structure. But my goodness, the next thing that we need to win is how to help you keep money, right? As much as it's easy for you to say, I know where market started and I know where price is going, when this moment in time happens right now, here, this is where a lot of traders lose it. And so you need a simple tool like the Fibonacci. Now, we said earlier on in our first example, markets leaving here, markets are coming there. You know this from your analysis. You've done the analysis, you've done the work, you know your supplies and demand, daily supply, daily demand, H4 supply, H4 demand. It doesn't really matter how you've done your multiple time frame analysis, right? You've mapped all of that stuff out. I'm talking to traders who have gotten through those basics and they're now in this trade. And all of a sudden, markets do this. This is what I mean. You need to be able to see the pattern, to see anti-Fibonacci. Once you get this situation, we call this a swing high and a swing low. This is your swing high, the first highest point of the logical swing. This is your swing low on the same leg, on the same market phase where price stopped going down and allowed you to draw a swing low. And looking at that, that is where you want to pull out a Fibonacci. This is what your Fibonacci is waiting for. You cannot draw a Fibonacci until the swing high and the swing low pattern is complete. Now, there are two types of Fibonaccis that we need to look into. The first thing you need to know in terms of which fib am I drawing is our favorite question from module 1. Where is price now? You need to determine that. Where is price right now? Price right now is over here. What's the second most important question when doing this type of analysis? Where is price coming from? I've been doing this drill with you guys since September, so I'm really hoping you're with me here. Where is price now? Price is right here, right here. Where is price coming from? It's coming from a supply. You have to be sure about that because it's going to affect the type of Fibonacci you draw. Where is price now? Where is price going? That's the last question. Remember, we know where price is going. We've done module 1, so we're clear with our multiple time frame analysis. Where is price going? If price is going to a demand, if it's going to a demand and has not yet arrived at a demand, the only logical conclusion you can make as a trader is that this is a retracement. If price had arrived at your demand, then it would be a reversal, and we're not even talking about a fib. It's time to just buy. Forget about trying to find a better place to sell. Forget about thinking about holding your sell position, because where price is going, if it has arrived there, it's over. It's not time for fib. But right now in this example, price is right here. Price is coming from a supply and price needs to dip a little bit lower. So we call this a retracement. Now, depending on your answer to question number 2, where is price coming from? And the answer here is a supply. It would naturally mean you need to draw a downward fib. This, I'm not even recording this. You know what I'm going to do? I'm going to download the video from my YouTube channel and then I'm going to upload it, because this is a little bit different from how I've taught Fib in the past. I mean, it can't be that different, but it might be a welcomed update in the remote course, right? So very important. Depending on where price is coming from, where is price coming from? Price is coming from a supply. Because it's coming from a supply, your Fibonacci is downward. Now, how your swing low, swing high works is you draw the Fibonacci at the top of the swing high, which is where I've put that little line, and equally at the bottom of the swing low. So now imagine I've drawn this correctly. Sorry, let me just sort of make sure. There we go. Right, so I need to really draw this correctly now. And it's not really so much about how you draw your anti-fib, it's about the candlesticks, right? So there, something like that, and then hopefully I can rub out this and that. Perfect, right? So I've drawn something similar, right? So right at the top of the top candle, the highest point in that swing high, and the candle that will give you the lowest point in that swing low, that is what you're using to draw your Fibonacci. I hope I'm clear. And because of where price is coming from a supply, you are selling, you know, it must sound logical. You are selling, you're going down, it's coming from a supply. The Fibonacci you're going to draw is a downward fib. That means you start at the swing low, you start at the top, and you simply drag your Fibonacci downward. You start at the top and you simply drag your Fibonacci downwards because it's a downward fib. All right, and if you're just here for signals, just be patient. I need to get through the teaching. But please feel free to like the video so far if you haven't. If so far I've said something that you actually like, that'll be very much appreciated, right? So we've got where's price coming from, where's price going, blah blah blah, and we've drawn our Fibonacci from top to bottom. This is how you would draw what I would call a bearish fib. If it was a bullish example, and let's see if we can move these questions here and also start to kind of like articulate this a similar sentiment, right? So let's say markets actually made it all the way down, and now we are rocking from a demand. If we're rocking from a demand, it means markets are going up. What do we need to see at that demand? You know it, we need dumb traders to arrive, we need a short base, and we need a strong rally. So now here's our rally happening. Here the retail traders selling in an area of value where demand exceeds supply. Never, you don't want to be these. We might be retail traders, but we want to learn how to do things like the banks. We don't want to be caught selling in a place where they're going to buy. If I'm selling a car, I need someone to buy the car. I might hate my car. My car might be a breakdown car. I know everything about my car. I know my car at gear 3 is a big mess. So what am I going to do? I'm going to try and sell it to someone who doesn't know better. That's foreign currency, right? That's the markets. Every time you lose a trade, you lose to a better trader who knew something better than you. Stop selling in demands. Just stop it completely. Don't assume. Never assume. This week started with a lot of retail. I took screen grabs. If you guys follow my Instagram posts on Sundays, I kind of like show you the mindset of retail traders, you know, over the weekend, and everyone rushing to buy stuff. People very sure of themselves. Yesterday, I showed you guys a lot of retail traders were confident that CAD, USD was going to be a buy last week, Wednesday, because they thought, you know, they can predict what the governor is going to say and ignored supply and demand. Naturally, I made a long comment that no one cared about. I got 1 like and people lost money. They did their own thing. This week has started off with people believing that EURUSD is a long buy, like a long buy. And I've taken screenshots of that, and we're going to see at the end of the week who's making money. Do not fall for this stuff. Never sell in a demand, never buy in a supply. Know your basics, please. Now, markets are rallying all the way up, and then all of a sudden, markets stop rallying. Right, so this is not, I don't have enough space, but anyway, let's just drop. Not nice at all, right? So markets, let's just use 2 candlesticks because of space, and maybe let's just make this a little bit bigger just to give us a little bit of space. And then all of a sudden that happens, right? That's even slightly better, right? All of a sudden you get red candles, or you get price starting to turn. So you're in a buy, you're starting to panic. Is price coming against me? Will markets take me out? Once again, you have to find out what anti Fibonacci thing. Swing high, swing low. Do you see it? Same. You see how it's slightly different? For selling swings, the swing high is right here and the swing low is there. Right. So the S faces this way. I don't know if you call it an S or whatever. For bullish fibs, it faces this way. Right. It's just a small, simple pattern that you need to remember. It's a small, simple pattern that you absolutely need to remember. So as price goes down, down, as soon as you can draw a swing, because you want to anticipate whether this is a retracement or if it is, how far it's going to go, you pull out your Fibonacci. So naturally here, you're looking at the top of the candlestick, right at the top by that swing high, and the candlestick at the very bottom of the swing low. And what you want to do, because this is a bullish Fibonacci, this is not a bearish Fibonacci like before, this is an absolutely bullish Fibonacci. You want to, no, that's not it. Right, so you want to be able to drag your Fibonacci from the bottom up, from your swing low to your swing high. That's simple, that's all. Right, and this is it. So for a bearish Fibonacci, you want to draw from the top to bottom because you're selling. From a bullish Fibonacci, you want to draw from bottom to top because when you buy at the bottom and you push price up. Right, two types of Fibonaccis. Difficult to do a temperature check, unlike class in YouTube, but can I just get one? If you're in the YouTube live stream, can I get a temperature check as usual, guys? Just like how we do our classes, yes or no? Are you with me? Yes or no? Is this clear so far? Temperature check, yes or no? Just type Y or N. There's somewhat of a lag on YouTube there. So I'm just going to keep going. And then when you guys finally answer yes or no, I'll have a look. And if it's a no, I'm happy to come back to this. Okay. I'm happy to come back to this. But in the meanwhile, as I move on, while some of you start to answer, I'm going to assume I've been clear. But if I'm not clear, don't hesitate to let me know. Right. Now, Fibonacci is a sequence. It's just a simple God-given sequence. And I've spoken to a lot of professional traders. I mean, I've spoken to professional bankers. I've spoken to a whole lot of people in the trading community. And some of them just don't believe in Fibonacci. So Nanny, good to see you. All right, fantastic, fantastic. Jay, Alvin, Miss Eunice, Alan, Mark. All right, cool. Mrs. Ntunzi. All right, okay. So I'm coming across clear. Right. So I've talked to a lot of bankers. When I did the Anton Krill course, ITPM, I can tell you right now, there was very little to do with technical analysis because banks don't care about technical analysis. Right. It's not like they're sitting there charting up Fibonacci levels, right? They find the fib very useful. Listen to this language. They find the fib very useful to use because everyone else believes in it. So they use that to know where on earth will they be able to find customers, right? If the banks are buying, their customers are retail traders who want to sell because they need to go against you to make money, right? To chow your money. Right, and fundamentally, some supply and demand traders think the fib is like a golden tool. Either way, whether you're using the Fibonacci to track retail trade activity, so you can take a winning trade against them, or you use the Fibonacci as a golden tool for your technical analysis. Either way, I think there's a lot of value behind the tool. Personally, I'm on both sides. I think it's good for assessing where retail traders are, especially that 50% Fibonacci level, which I'll show you right now. But also from a technical perspective, after back testing, it is a clean winner. Now, there are certain levels of Fibonacci. And like I said before, guys, the Fibonacci, if you don't know, is in everything. The Fibonacci was not even literally designed for trading. Fibonacci was a mathematical sequence by some Italian guy who died a long time ago. And basically what the Fibonacci does is it breaks down an entity, right? All entities can be measured by 100%. If you just completed last week's course with me, classes with me, remember when we do our supply and demand curve, we're always thinking 100%. And then we chop that curve up into quarters, into 10 points, just to assess bearish territory and bullish territory. The Fibonacci is exactly the same thing. It does the exact same thing. It chops up market phases into not necessarily equal parts, but into common revisited parts with crazy mathematical accuracy. But just so we're clear, I have this phone here. On this phone is my fingerprint and my wife's fingerprint and our faces, right? Facial recognition on my phone. CCTV cameras at the airport, or when they scan your passport, it goes to a database. All CCTV cameras around the world use a Fibonacci sequence. So the symmetric sides of my face, everything can be broken down to a Fibonacci sequence. So when we're trying to match criminals on the database, and what someone would, when someone draws a sketch, a detective draws a sketch and says the criminal look like this, and they get someone to draw it out, they run that through a database, and through a Fib sequence, it will reconstruct the most plausible match, and sometimes, most of the times, is extremely accurate. Fibonacci is in everything. It is simply a mathematical sequence that breaks everything up into key specific figures. The ones we're going to be looking for in trading are the following. And please understand, I've evolved with time. So I don't really care about all of them anymore. But most of them, I'll give them all to you tonight, but I don't really care about all Fibonacci sequence numbers anymore. Right. The first one is obviously 100%, and right at the bottom, there'll be 0%, right? That's kind of like a given. 100% at the top, 0% at the bottom, almost like our supply and demand curve. Now, the next Fibonacci sequence number that we want to focus on in general, and maybe let's start off with this one. This is 78, I think it's like 78, something, 78,1 or whatever, 78, something percent, somewhere there, something like that, 78 or 76. We'll check on the charts, right? But this is the one I want all of us to focus on. We call this the golden number, the golden ratio of Fibonacci. It's 61,1%, 61, something percent, 61,4. I don't know why my brain is catching blanks today, right? This is big. This is the Fibonacci sequence number I need everyone to get obsessed about as a trading tool. The stuff that happens here is golden. All right. The next Fibonacci number is 50%. 50%, guys, is generally always in line with retail traders. So it's definitely worth looking into. Just please don't be caught on the wrong side of the trade, because the banks know a lot of retail traders are looking at this number. Number one. Number two, when you draw a Fibonacci on a chart, look carefully at that 50% level. You will see that it carefully aligns itself with a lot of support and resistance. So if you know how to trade support and resistance, you will always get a lot of 50% confirmation there. Banks know this. So stop hunts will always try to breach 50% support and resistance before dropping, right? This is a good place for liquidity rate. That's why I say use it very wisely. You can take a 50% if the 61 is too far and the 50% has a very strong order block, right? Otherwise, in general, always wait for the golden ratio. That's generally my rule. It's part of my trading plan. I no longer care. Sometimes, if I need to be in that trade and the emotions have taken over and I can see that there's a good trade, but it's at 51%, and if my risk management allows or my account size allows, I won't lie to you, I can take an entry point at 50% as long as my stop loss is outside the 61%. So this is a very wide stop loss if you really think about it, but it gets me covered. In the event that it's a fake out and markets don't stop at 50 and first climb to my golden ratio, I'm still in the trade. A wide stop loss generally requires a stable mind, a mind that sees red but understands the plan, right? Some of you can't hold red equity for more than 2 hours. You panic. Some retail traders don't think it's possible to even hold a swing trade for more than 3 days. That's going to be a problem. Remember, if you're new to the course, and when I say new, you've just started the live class or you've just taken the remote course, our deal, and if you don't know this, I'll tell you right now, because you've joined 365, you are not trying to be a millionaire until, please, if possible, going to explain liquidity rates. Yeah, sure. 61,8. Thank you so much, Eunice. Thank you so much. That's correct. The golden ratio mark is 61,8. Right, I'll fix that later. Right, so I'll say 365. That's kind of like the deal. The deal is you are here to realistically grow your account, and you're going to need yourself a good year. It's not like you're not going to see progress only after a year, but I'm saying good risk management. Most of you are going to start with small accounts. You must see this grow up. And what I've asked a lot of my students is for the first 4 to 6 months, if you could just, before you jump into small time frames and go out there and have a party and call yourself a full-time trader, you first master the swing process on higher time frames. Absolutely crucial, because if you can do this, it means you're looking at H4 to daily entries and H4 to daily supplies. And a lot of people are like, oh, Leroy, no, this is not good. No, I never make money. Anyone who tells you that just doesn't know how to trade, period and point blank. It's not a difference in strategy. It's not about strategy here. If someone tells that you cannot make money on the daily time frame, they don't understand the markets, period. There's nothing wrong with smaller time frames. But I'm saying for those of you who are starting fresh from the start, if you want to see actual growth in your trading, you are going to have to first swing. You're going to have to grow $100 to 400, 400 to 800, 800 to 1,200, and actually go through a trader's process before you can start to drill down and play with the big boys, or fast-paced boys rather, fast-paced boys and fast-paced girls, which is intraday time frames. This is so important that you understand this as a trader, because most of the movements that choke you out on the smaller time frames are still within the entry points and stop loss levels of H4 daily. And so in tonight's class, and as we back test and we do a trader's war room tonight, as we go through a lot of currency pairs together in the next, I've got about 10 more minutes before I start running a lot of signals right now. I will be doing the Fibonacci on H4 to daily, because you must see the power. If you guys have read with copy is too far to stand up and one is in the car. Currency, the book I've been asking everyone to get onto, which I still need. I did the withdrawal, by the way, so I am ready to buy 100 people a copy of The Adventures of a Currency Trader. 100 people worked out to about 51,000 rands or something weird like that, to be a Kindle version. So if you're not a 365 trader, look out for my posts on social media from this weekend or etc. I've done a withdrawal for that. That's a phenomenal book. Right, it's my biggest gift to you. Read it. Later on in the story, on page 100 and something, when Henry Barnes finally meets the guy who taught JP Morgan how to freaking trade, it's literally there on page 100 and I've forgotten, man. I can pull it up, where they literally mention if you're going for H4 to daily, you're going for big grabs. That's big market movement. A lot of people would have been out of EURUSD if they focused on the 15 minutes chart on Friday. And in fact, a lot of people did get out there, because on 15 minutes chart, 1 hour chart, there were multiple H1 demand. There was a bullish engulfing pattern. You think I'm making this stuff up? I am not making this stuff up. I know we're talking about Fibonacci, but let's move the whole class to the charts right now, because we need to do some chart work anyways. And I did say I want to start off with some EURUSD. I did say I want to start off with some. Okay, so this particular chart that I have here has a lot of notes. We'll come back to it at the end. Let's start off on a clean chart with no notes. This is what's happening right now on EURUSD. Markets fell there on Friday. This is a whole drop. 365 traders. I just taught you this stuff last week, Tuesday or Wednesday. Would this not have been a demand you would have been worried about? I would have been worried about that demand, because that particular demand was in the way, right? If I was looking at markets from a perspective of Thursday, which I was, and I did say this in class, by the way, that I was actually worried about this trade. I told people I didn't like how violently price came into this area of value. It's not clear on the H4. Let's go to the daily time frame. Let's go to the daily time frame, so I can first show it to you now, and then we can back test it so we can see if I'm lying. Right, so this was probably Wednesday last week, right? This is the 27th of October. I just want to double check. I know I see it on Fibonacci. I'm gonna go back to it right now. Don't worry. Let's remove everything. I don't want any notes there. I don't want to cheat. Right, the 27th of October was Wednesday. I am right. So 27th of October was Wednesday. This is what markets looked like on Wednesday. All right. And that was fine. That was absolutely fine. All right. I'll explain why, but just so you know, we had spoken a couple of weeks or days ago that there was a good supply here from September, right? So when we did one of the war rooms at the end of September, I said this will be a good place to come wait to sell. There's no time to prove this, but if you go through my social media, 365 social media, on the Facebook page, there was a day of the week, specifically on the 21st of October, I posted this. Morgan Stanley, a big trading institution, literally said on the 21st of October that they still believe price could make it down here to the 1400s. And so on that particular day, markets sold off like crazy. Right, so you can see there's a red day there, and I had a pending order up here, so I wasn't triggered. And my post on social 365 page just a week ago, you can literally scroll back, you'll see the screen grabs of the news report from Forex Live. My post that day, I literally said, look, man, being disciplined, this is the cost of being disciplined. My pending order is here. That's what my trading plan is telling me to do. Now that Morgan Stanley has said they foresee price dropping a little bit all the way there, not necessarily this number, but in the 1400s, right? Somewhere a little bit lower, somewhere there, etc. A lot of retail traders, a lot of institutions, smaller banks sold that day, and it would have triggered FOMO. If you really knew what that article was saying, you jumped onto the trade, because here's a big institution saying, yeah, we're still holding our shots for euro, we're still gonna go down. And in my post, I say, I'm not doing that because I need to be triggered in the trade. I've already planned the trade. I'm going to trade the plan. Most of you have a plan. You've got pending orders, but because you're pending orders, markets are taking 3 days to get there. On day 1, day 2, day 3 of waiting, you take other random trades that you have not planned. By the time price gets to your area of value where you are actually right with sober analysis, you don't have an account to trade anymore. You need to stop doing that, right? So markets fall for another week. And I would have given up, but it's unlike me. Generally speaking, I see my analysis through, and then naturally, this is probably the 27th on the Wednesday. This is what happens on the Thursday. Too fast, too fast. I apologize for that. Let's do a replay because it's very important. Right. So on the Wednesday, markets keep going down, and then on the Thursday, markets push up. Pause. This is what happens. So all of a sudden, you have to think about this. Guys, when I treat you trading psychology, you're going to be so shocked how it's extremely technical. You need to understand what smart money is doing. If I'm smart money and I want to bid, you get 2 prices, right, in the markets, an asking price and a bidding price. That stuff is so important, the business side of trading. Look at what they did. Every single person who sold here, Morgan Stanley said, they are definitely happy to see, and they believe in their commitment that Euro USD is still going to fall all the way to the 1400s. They did not say they sold today. These guys have been holding sells all the way up here. I can guarantee that. Well, the first time we started selling Euro USD, and when I said stop buying Euro USD and start to hold sells, they've been holding probably for much even longer. So you create a market here of sellers. How am I, Mr. Demblin, here's a perfect example for liquidity rate. How am I about to get all this money? These are sell orders. Anyone who's selling here on this red candle here, on this bearish engulfing candle here, all of these guys believe that the conviction behind this, the markets can't go any higher, markets have to go down. So all I have to do as smart money is to put enough pressure to the upside to liquidate every single sell position. Why? Because not only can I make profits by holding long-term swing sells on one direction, which is the downside, I can also make money by hitting every single person's stop loss who is selling a little bit lower than I need them to by just simply running a buy candle through. So I buy, I outbid the sellers. I buy out all the sellers. I extinguish every single sell position. And guess who gets triggered? I did. And anyone else in 365 who took this trade with me, right? A lot of senior traders, we got triggered in. We were like yippity hoop, doopity doop, because markets have come back. Trust the plan. When we do warrants from a week to week and I give you pending orders to go mark out in your charts, All you have to do is set the pending order, check your capital, risk properly, keep track of how many pending orders you have, how much free margin you have in case something goes wrong, and you go on with your business. You slowly but surely, it'll start off very slow. It'll be $10 here, $20 there, $30 there. You blink twice, 2 months have passed, and money starts to accumulate, because generally speaking, smart trading is one that is heavily automated, of extremely mechanical. Right. So the reason why a lot of you get stuck in trading is because most of your trading is not mechanical. For example, if you're a day trader, you're going to have to be doing a lot of market execution. There's nothing wrong with that. But if you don't have a trader's mindset, you're going to fail at it, because market execution requires you to trust your strategy 1000% and execute immediately when the signal presents to you. I got triggered in EURUSD when I was doing some random dumb stuff. I don't even know where I was or what I was doing at the particular time. It was 7 p.m. I was in class. I was literally teaching when I got triggered on a trade I marked up 2 weeks ago. So I didn't wait for confirmation candles or confirmation bells or whatever. When I noticed I was triggered in class, I remember saying this to the class, I'm actually worried about this trade. Why? I didn't like the strength. EURUSD came very strong. Look at this, bullish engulfing pattern. And this is why bigger time frames will always win for me. Right, there's nothing wrong with intraday, and I finally back tested enough. I'll post the chart tomorrow of my performance trades on indices, just on intraday, about 1,116 points in the month of October in indices. You'll see my graph, my equity graph. You must see this stuff in real time and real time stamps, so you actually believe for yourself that you can do it. But look at this. If as a trader, if I've taught you before, this is strong. We just did this last week. This is a bullish engulfing pattern. But don't forget multiple time frame analysis. If you look at your governor is dropping. Your governor is dropping. Your governor is dropping. Do not forget the basics, module 1 basics. So we've got a price leaving a supply. What are we doing? We are selling. Selling until when, Leroy? We're selling until banks are done selling. Banks are only going to get done selling all the way down there right now. I mean, if you don't know how to draw supplies and demands, or what makes a supply or demand, again, the remote course, the full traders course is 67% off. It's $100 versus 300 for the first 100 people. Then price just goes back to normal. So I'd really rush to just sign up for that stuff if you want. If you don't want, good for you. Right, but look at this. Markets removed a demand. We've got so much confirmation from this chart. And still today, right now, last night, I know there are a lot of retail traders who are buying this thing. They're buying it. So once again, when the selling starts, it's their money that we're going to take. Once again, for the 1,500th time on this one chart. Once again, retail traders are pumping price up. Some of them will say they are being, counter trend traders, which is fine if you know when to get out. But if you think euro is long for a long time, you're crazy. And in the war room, I'm going to start breaking that stuff down right now. But anyways, price removed a governing demand. So now markets must drop. Weekly time frame. Simple setup. How would you know? How would you know that euro was going to turn there on Friday? Fibonacci. I'm going to show it to you right now. Now on the daily time frame, this is what we have. We have a very strong push to the upside. We've got my order block there, 365 order block. Can you guys identify anti-fib? I did it with you in a war room in September, but I don't know if you remember. This is my swing high. This is my swing low. So that means whenever I did that war room with you, this is what price looked like. The last time I did, if you just bear with me for a second, my war room with you, this is what price looked like. I in fact remember attempting to do a swing low, swing high when markets did this. There was one fib here and then another fib down here. As when I realized markets fell to think there's a fib level here, it's called the PCP level. It could be 23, something or 38, something, where markets will continue to the down end. But we finally got a swing high, swing low. So now you come to this tool here. See this? Fibonacci. This is the Fibonacci place. Do not use any of these. Fib resistance, fam, I'll teach on these another time. You just want the simple old school, it just says fib retracement, simple tool. This is a downtrend. Why is it a downtrend? Where is price coming from? It's coming from a governing supply. Has markets arrived at a governing demand? No, it has not. This is a market leg. You see there's swing high, swing low. So at the top of my swing high, I start to drag down my Fibonacci. I drag down my Fibonacci from the top of the swing high to the bottom of the swing low. Right, so now I need to make this a little bit neater for you. Let's remove. I'm just going to remove all the things that I don't need in the way. Right. So I'm going to remove the swing high, swing low because you can see it. Right. I mean, it's clear. Right there. I've got something like this. Now you will see off the bat, I've already removed a lot of levels. Like I said, I no longer take PCP fib confirmations. Had I taken one, I would have known to sell there. And just so you know how to do that, you can right click on your Fibonacci. Not right click, so you click on it and then come to this symbol here, settings, and then you can do visibility, or sorry, style, and you'll see that there are a lot of levels that I haven't ticked, that I personally don't need. But if what's missing is 23.6 and 30 is there, 38.2. So generally speaking, a default Fibonacci looks like this. You see these numbers? These are the numbers I was telling you about. 0, 2, 3, 3, 3. There's the 50%. There's 61.8%, 78%. They're always written out in decimals, but this is breaking this from 100%. So this is a market leg, guys. This is the phase that we want. We want to know where the retracement will be on this market leg back in time. Another market leg is somewhere between there and there, give or take. Told you that markets will always consolidate every now and again, then continue their journey, etc., etc. Now let's focus on the current market leg here. So I've drawn my Fibonacci top to bottom because once again, that is all I have in terms of Fibonacci confirmation. Now, and in terms of the current leg that I'm dealing with. Now, I'm assuming that those of you who are rocking with me right now are supply and demand traders. You've done the course because, again, it's a war room and I haven't even gotten to the war room part of things. So because of time, you will accept that there's something called order blocks, order flows. You'll accept that I've taught you 5 types of supply and demand on module 1, right? And this is a PCP area of value. So if you look carefully, when I drew my fib, whenever this was in the war room, swing high, swing low, I start to realize there's a cluster here where selling could occur. That's true. There's a peak supply there where price could come to. That's also true. Then there's an order block here as well. 365 candle where price could come through. I've got 3 specific places where price could come through, right? And all these places exist independently as themselves as areas of value that price can come to. If you look at the leg, so if today was the 13th of October, sorry, and you're looking at price here, price had a couple of options, to be honest with you, some valid supplies. For example, complicated 365 candles. That's a supply that I taught you how to use, right? So you could assume that's a strong push into an area of value where markets are going to drop. That assumption would not be insane. 365 candle. That's a supply order block. That assumption is not crazy. Talitha areas with a bearish engulfing pattern. That assumption is not crazy. Peak supply right at the top of the leg. That's okay. Well, that assumption needs to be tested amongst where is price. Historically, you know, markets have been reacting to this supply up there. And then we do a little bit of this. Okay, that's fine. So no, so just here. So this is a reaction to that, but it is a peak supply. So markets could do a double touch. So you've got all these assumptions about price here. You've got about 1, 2, 3, 4 supplies. How do you know which one to choose? You're trading today, it's on the day chart. How do you know? If you go to the H4, I promise you, you know, I don't think it adds with the clarity, but you can refine your areas of value. But how do you know? From our trading strategy, how do we know which one to focus on? We need the Fibonacci to narrow things down. The Fibonacci is literally what I'm doing with the remote course right now, or the 365 traders course. And I'm not trying to market this thing. I'm trying to like find the most basic examples to bring you the stuff in. If you've been following me for a long time, and you want to join 365, but my course was $300, and you're like, yeesh, that's expensive, right? Despite the fact that when I learned how to trade, and it's on the website, right? If you go to Online Trading Academy, Supply and Demand, their course is 21,000 US dollars, right? It's 7,000 here, 12,000 here for the full thing. I'm selling for 300. Well, my version of it anyways. But if this is a lot for you, right? And then I said, okay, fine. If we, between now and up until we get 3,000 subscribers on the channel, we'll go half price, 150 bucks. And they're like, yeesh, that's crazy. Well, now it's November. My team is like, Leroy, it's November. Do you want to do a Black Friday? I'm like, yeah, go for it. They're like, should we make it 120? I was like, nah, let's make it 100 bucks. This is it. This is a discount. So those of you who know 365, who've been following me, but struggling with funds to join, this is a 67% discount on $100. If you already know about our reputation, you are more inclined to buy now because it meets your budget. True or false, right? Yeah, basically, right? But in the markets, this happens all the time. The same thing that you want to trade all the time goes through a retracement. I want you to start thinking about retracements, right? If you cannot wrap your mind around retracements, start to view retracements as discounts, as markets discounts. There is a discount in the market. Now, same example with Euro USD. Price was at, and let's go back to the charts, because I really want you to get the stuff. It's so important you get the stuff. If, remember, you are buying and selling units in the currency market. I know some of you are just trading for fun. You don't even know what you're trading. But if you're a 365 trader, remember, it is units. We're buying an X amount of units of the currency or selling X amounts of units of the currency. That matters for lot sizing, leveraging, risk management, but also the business side of the trading. The business side is, I don't want to buy flour, eggs, cooking oil, yeast, whatever the ingredients are to make bread. If the ingredients to make bread cost me $10 to make one loaf of bread, I never want to find myself selling that loaf of bread for $2. The business side of my bakery is flawed. I am making a loss by every single product. Same thing with the markets. If you had sold up here, you are the most profitable trader in this current leg right now. If you joined us and took this sell based on this turning point supply with a beautiful imbalance, you have the most money. You have made the most pips going down. You have made the biggest leg. You've been in price for the longest. You also sold at the highest point. It's the swing high. It's the swing high. You sold up there. Good for you. We spoke about this sell. I hope you guys took it. Now, as prices dropping and dropping and dropping and dropping, and let's say you only found out about 365 2 months ago, and you want to jump into the Euro USD leg. Why? Because you realize that this is potentially a retracement. Why do you realize that? Because markets have not yet arrived at the governing demand, which is down here. Now, if markets haven't arrived all the way down here, it means every time price goes up, markets are simply retracing from their long-term journey. Long-term, Euro USD is going to fall. I've been saying this for months. It's been falling for months. It's going to continue falling. Believe you or me, Euro USD, there are going to be up days that will confuse a retail trader to think the Euro bulls are back. It's not going to happen. I can put my entire reputation. We'll have buy, so I can keep selling better. Right, and that's what happens. This is the discount factor in price. Now, this thing was selling up here. Let's make up some numbers just to make it make sense. It was like the 365 course for 300 USD. You want a piece of Euro USD. You cannot afford it at 300 US dollars. And so now I'm telling you, with the combination of order blocks, if you've done the course, the Euro USD is now 67% off. It's a discount. So instead of buying it for $300, you can own some Euro USD, if you understand my example, for $100. Guys, this is a bargain. The same Euro US dollars that Leroy owns, that he bought, this example makes more sense in the crypto markets. If crypto is crashing, it's time to buy because it's falling. It's not going to disappear. Forget about the rumors. The asset is cheap for a short time. Jump on the discount. right? Except if it's a shit coin. Be very careful about that, right? So now it's $300 here. Markets have dropped off to 67%. Right, that's the basic example. So now what I want to do is to be in line with the governor. I want to sell, but what I want is a confirmation bias. I want to make sure that I am selling at the right place. So I draw my Fibonacci, and what the Fibonacci did, you know, if we remove this 67% in this crazy example, you will realize that the 365 order block is literally between 50% and just at the helmet of 61.8%. And when we draw our areas of value correctly, the way I teach you in module 1, where you have to take out the reasonable body, this is kind of like what you're looking for. Now, with market crisis coming, if you remember, I keep telling you guys there's a market crisis coming, I now cover my entire order blocks, because anything is touch and go for price. Price moves a little bit faster. Markets get freaked out a lot easier. There's Fed tapering on the 4th of November, which is 3 days from now. The FOMC most likely will announce a confirmed taper 3 days from now. When they do that, the dollar is going to be strong 3 days from now. Today, we've got retail traders buying Euro USD, when 3 days from now, on a scale of probabilities, the dollar is going to be strong. I don't know how else to come across to traders, right? The stuff is not hard, but you're going to learn it. Now watch this. Now, because of my confirmed Fibonacci, when I drew my swing high and swing low, I realized that the best outcome, the safest place to wait for price was at the discount area, somewhere here at 61.8. I definitely told the class that, and I told you guys on the public Telegram group. I remember on Friday, I told you, I said, EURUSD has made contact with our pending order, break even, put a new sell limit order at the same place, put another sell limit order above, and hold that trade. I literally said something along those lines on the public Telegram group. You can go double check that. So all we did from that war room was to simply wait for price to come. Why? I have confirmed my bias with the Fibonacci. This is it. This is my golden ratio area. It would have been far much more better if I was on the other side, but this is good enough. And then all of a sudden, that means I no longer am interested in selling here. Why? As much, let's say there were 3 candles. I know someone's going to be like, Leroy, it's not an imbalance. Let's say there was an imbalance. It is not a good place to sell, because I now know that there's a good, better place where you can get a 61.8% discount. Most institutions will do that. This morning, I filmed a video called Bitcoin Futures. So basically how the futures have impacted Bitcoin. I just didn't want to upload it today in case it confused people about the war room and they thought that was the war room. So I'll upload that video first thing tomorrow morning or tonight. Check it out. Because what's happening to Bitcoin is institutions have come into play. So they're going to suppress price down first. Now, because we're selling here is not selling high. This is a low sell. This is a sell low when you compare the two. So if I want to make the most of my money, thinking like an institution, right? If I want to make the most of my money, this is the sell high. This is a better sell high. Far much more better in comparison to the very first level. This is where your mind wants you to sell. The person in you who has not yet become a trader wants to sell here because you want to make money now. You think it's cool to always be in trades. You think every day when you see price go up and down on your MT4, MT5 platform, you're doing the work, you're trading. Absolutely not. The real money is at a place with high confluence. I have an order block. I have a Fibonacci confirming, and I'm trading the direction. The next better place to sell is even higher because markets will consistently seek out higher places to sell. I am waiting here for price because my Fibonacci has told me. So the next day happens, and that happens inside that zone. I'm just going to speed this up a bit because we've wasted a lot of time. And then markets go up. This is where the Morgan Stanley price turns, right? Price turns there. When I told you that Morgan Stanley article came, a lot of people started to sell. So my orders were not filled. And then all of a sudden, you can't time the stuff. So you need to always be prepared, because I would have not have known that Thursday would have been the day fundamentally for this big push to happen. I would not have known that. But on Thursday, our orders get triggered. On Friday, markets bled out with a bearish engulfing pattern. Now, because you don't understand order blocks, a lot of people, not 365 traders, they are seeing green today and they believe it's a long-term buy because markets are going up. And if you look at the distribution of charts, markets are not coming up parabolic on the 1 hour time frame. You've got a zigzag pattern, you've got, order block, order block, order block, prices coming up in beautiful stages. Can I tell you something? If you don't know this, bearish engulfing patterns, both bullish and engulfing, need to be retested. Bearish engulfing patterns, both bullish and bearish, need to be retested. So if you're holding EURUSD, all right, and maybe you should or you shouldn't, just depends on the type of trader you are. We need this green today for us to continue to the downside. If markets want to continue to the downside, right? This is remember those 365 candles, good enough for one touch. Remember all the rules, your brain must move. So you have to protect yourself, break even, take profits. So for me, 3 positions, I closed on Friday. I was 100 and something pips, wasn't going to let that go, number one. And then after that, I had to then draw a new fib. But let's first finish fib number one. Fib number one has worked out, markets are retracing. So now let's say, because I've got one more sell trade open that I want to hold for a very long time, if price allows. The sell was activated here on the daily time frame or H4 time frame, whatever time frame. And this was a beautiful drop. When we come to H4, look at this. Do we not have a retracement, ladies and gentlemen? Markets are retracing. Markets broke this demand here, and now prices coming up today being Monday. But on the same breath, I have a swing high, swing low. So the thing about fib is it's a continuous activity. You have to manage your trades like that. Shake my hand, my brother James. Dude, you're watching this live. Good to see you, dude. This guy just graduated his master's degree in global value chains. I'm super proud of him. Did his master's degree like me in 1 year. Well done, Brandon. I don't even know why he's here, but good to see you, brother. Good to see you. Right, so look at this. On the H4 time frame, markets have created a new swing high. Remember, we drew one on the daily and we took the trade, because the Fibonacci confirmed it. Please focus. The first Fibonacci has worked. It's given us this entry. We sold on Friday. We're in profits. I posted it. You should have been in the trade. We all made money. Hip hip hooray. But now markets are retracing again on H4. Why am I saying retracing? I don't think markets have arrived at a daily demand. Let's check the charts. Maybe they have. All right. So there's this daily demand here, which is fine, which is pushing price back. But don't forget, on the bigger time frame picture, we have a bias that price has to go away, all the way down there. So if that's our bias and we want price to push price a little bit lower, it's safe to assume it's a retracement. But let's say it's not. Let's say you're like, but Leroy, that's a daily demand. Where is price going to go? Well, markets have to move from demand to supply. Is this a bullish engulfing pattern? Yes, it is. Is this a bearish engulfing pattern? Yes, it is. So markets have left a demand and arrived at a supply. So now my assumption, my bias is price has to drop. That's my bias until markets prove me wrong. And if markets prove me wrong, I now know that markets want to go sell at the next high point. So in the H4 time frame, if markets have arrived again at a daily supply, which is a bearish engulfing pattern, I need to know where is the next best place to sell and where to move my stop loss for the first sell I took if you're still in the particular trade. So once again, same trick, swing high, swing low. Sorry guys, I am prioritizing class. It's very important my students get this stuff, but I will be doing signals in the next few minutes. I will cover a couple of trades. Right, so look at this. There we go. So I pull out my Fibonacci. Right at the top there, it's still bearish. So top to bottom. Swing high, swing low. I feel so energized to see my little brother here. Maybe he's gone. Maybe he just came to say hi. But I very much appreciate you, King. Good to see you, man. I've got two brothers. Safe, you guys know Safe. He's a trader. Then my other brother who's just into everything else. Bless his soul. Right, so look at it. So I've drawn a new Fibonacci. Now, there's my golden area here. This whole zone here is that 61.8. It's my golden area, number one. And then number two, we've got this 50% area here for retail traders. And if you look very carefully, like I say, 50% is known, historically or just in general for a lot of weird activity, not weird, but that support and resistance stuff. So you can see markets were in a range here. Every time markets came up to this 50% mark here, markets bounced, got rejected, right? So it's a good resistance point, which markets broke through, right? So these are my two zones. I want us to really concentrate on the golden ratio in general. I like, unless if there's a good order block here, nothing at the top, right? So I'm just going to delete the 50% because I don't want us to get confused. This is what we have. Now, as a 365 trader, we have a problem. Not really, but kind of. So can we all agree? You all saw that's the 61.8%. Now, it means something might happen there. The problem is we don't have an order block. Fibonacci is just a tool. We don't trade tools. We use the tool to confirm an area of value such as supply or demand. So until we find a supply, that's just an area of interest. It is not a place to execute a trade until we find a supply. And for some of us who are starting off on this course, you might have to stop here in your analysis and say, all right, I can't find a supply. The only thing that you can do is to take the sell that you took on Friday, move it to break even or even lock profits just above this zone. That's option one. But option two, if you're really good at multiple time frame analysis, is to look for a supply. So now I've dropped to the H1 time frame and there's still nothing. I mean, these doji candles here are an indication that there could be a supply, but you're gonna have to find it. And on the 30 minutes time frame, we drop. So there we go. So all of a sudden, this is what we have here. We have Talitha areas and then a drop. So we've got drop, base, drop, right? Which is not the same as rally, base, drop. The difference between peak supplies and every other supply, right? So we've got that situation there. And then we've got our bearish engulfing pattern right here. So if I extend this zone, this is all on the 30 minutes chart. I get a sell interest area that looks like this. Guys, if I'm losing you, you gotta talk to me. If I'm losing you, gotta let me know. You gotta let me know because I don't want you to be lost, right? This trade, I literally took this trade off fib and a PCP confirmation. That was 157 pips at 0.10. That's $1 per pip. You know, and the pips could go up depending on your lot size. That was really good money on this day. And I'm saying there's a high chance that look at this market inefficiencies. They gotta get filled. Look at that. Sell, 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 sell. This is what happened to people who are using small time frames. Using small time frames, you got scared here. Probably got out. Probably got out here because you thought this was going to be a demand and markets were going to break, not knowing that they created a big enough supply here to smash you through. The whole day Friday was a red day, and now markets are moving up. So now I'm going to mark this area carefully and then leave it as it is. I've adjusted to the 30-minute time frame to my supplies and demands. I'm covering both for now. And then we're just going to go back and double check to see, you know, as of today in the morning, I can't draw a boundary. I don't know why. Oh, it's too light. There we go. Right. So you can see the red boundary on the yellow square, right? There's a red boundary on the square. We are going to go back now to our H4 daily time frame to double check this red boundary without adjusting its width, right? To see if it still falls within our 61.8% golden ratio. So I'm going to draw the fib again. So you see on the H4 time frame, price still feels a little bit parabolic, right? And when I say parabolic, it's too straight. I want markets to distribute, to trade a little bit sideways before hitting this area. Now let's look carefully. You see this line here? This is my golden ratio lines right there. One, this is where the golden ratio would start. There, that white line, this is where the golden ratio would end. Number one, and out of interest, white line is that 50% mark right there. So out of interest, we're just going to draw it. Then we're going to go back to that 30 minutes time frame to see what's cooking. I'm going to delete the Fibonacci. All right, I'm going to delete this white line at the top. There's the entry point on the daily. Just wanted to confuse us. So those are only 3 white lines we're looking at. The first 2 are the perfect golden ratio area. And then the last line here is at 50% mark. So then I'm going to flip to 30 minutes. Look at that. So this is 50%. I'm going to remove it. So right at the beginning of the golden ratio, we have a supply on the 30 minutes time frame. You guys see this stuff, right? And within the golden ratio, we have a second supply. A second supply right here. The little area and the big drop. So naturally, as a trader, let's say you didn't take the true swing, because remember, I was telling the class last week, there's always a true sell and a true buy on any chart. One true sell, you get it, it's the peak supply or the value-based demand. All these other entries are supplementary. Smart money can use them, smart money can break them, right? We just have to trade on a scale of probabilities, right? So sometimes it will work, sometimes it won't. Most of the time it will work more times than it doesn't. That's just the nature of trading on a scale of probabilities. But now I can go, all right, so if there's a supply here that touches the line of the golden ratio, I can extend my entry point here like that. And then if there's a supply within that golden ratio, I can extend my stop loss value, something like that. And then hope for the best. This is for someone who now missed the true sell on Friday and is looking to get into some action, right? This area of value is worth 48 pips, number one. For the rest of us who ended at the top there, we took some profits when price dropped, number one. Number two, I did leave one trade running. So that one particular trade, I've already moved my stop loss outside this area of value, you see? So now, and then I've entered a new sell limit order around this area, by the way. So now if markets come, let's move this out of the way. This is the pip count, it's 48 pips, we know it. So now my thesis is here. If markets come tomorrow or tonight or the next day, whenever they want, I hope it takes another 2 days. I hope markets, or like another 24 hours. I just need to trade a little bit sideways, a bit more, but you can see it's already arrived. It's already here. So I'm saying if markets come in and the PCP doesn't hold for whatever reason, and my stop loss gets hit, I'm only losing money on the supplementary trade, and I'm taking profits on my last running trade, which will naturally cover my losses. For me, someone who entered on Friday, that's good. For you who's entering today, if you're one of those people entering today for the first time in this trade, this is the risk you're taking. You are taking a PCP trade. You're not taking a peak supply, right? So it comes with those kind of risks. That's why peak supplies are in my trader's edge. I prioritize peak supplies. You gotta get into that habit. And remember, with our 365 candle up here on the daily time frame, that's already been hit once. This is a drop. So that area of value is now weak, glass effect. So what we're hoping to see in the next 24 hours, 48 hours on EURUSD is price entering this golden area, which is the new Fibonacci you've drawn, and dropping. Guys, if it does do that, I would implore you to come back to this video on the YouTube channel and just comment down below that it did work. Obviously, I've got a pen in order, so I'll know that it did work. But this is how we use Fibonacci's. So this is what it looks like on the H4 time frame. It's a blind sell. The order blocks we found on the 30 minutes time frame, but on the daily time frame, H4 time frame, there is no order block unless you think about it logically. Let's go back to the daily. Remember, as we spoke on the daily, we said we've got a bearish engulfing pattern. So that means on the daily time frame, we already have a second supply here like this. So all we are seeing or projecting, oh my goodness, guys, this is such a good class. Temperature check. Is this stuff massaging into your medulla oblongata? Are you guys getting this stuff? This is wild. So all we have is a 30-minute supply if you're thinking in small time frames. But ideally, what we want to see on the big time frame, on the daily time frame, is a push. We want to see price buy in. We want dumb traders. We want retail traders to keep pushing price into our zone. How do you draw a good supply on a daily time frame? You use the reasonable body. So if I could extend this rectangle here, there, that's it. Reasonable body, and you see this arrow there marks my area of competition. If you know what I'm talking about, or if you've been vibing with me, you would know. But look at this. All we want is price to push in, right? So markets could touch here and then drop immediately. They'll use the daily supply, and then you're screwed. Just like how markets just touched the beginning of this order block and then immediately dropped. All right. I'm in the zone. Thank you. Thank you, sir. Right, cool. As long as you're in the zone with me. Right, but if we get a stronger push into the zone here, which means we could get another green candle tomorrow. Starts off green, starts off aggressive. Buy, boom, until they fall into a supply trap. And then what happens? We expect price to continue down. Now let's look at my bias to the downside. Well, we've got an order block here, ladies and gentlemen. It's a bullish engulfing order block. That is what is currently holding price. If we're to draw the entire order block and the area of competition, would get a big mess like this. Now, how do we assess the strength of our order blocks? Well, ladies and gentlemen, we have to know halfway through that order block if price has used the orders. If markets have used more than half of that order block, that area is weak. It's not to say it's not valid, it's to say it's weak. It's to say it's bound to break. Do we have proof of this? Is there proof that bullish engulfing patterns on Euro USD are breaking? We've got lots of proof, tons of proof. But tonight's class is about the Fibonacci. But we've got lots of proof. There it is there. So markets dug in very deep. There are so many bullish engulfing patterns on smaller time frame on Friday that got smashed. Direction. Right. I want to end it here in terms of class. Right. I want to get into some war room trades. I'm aware of the time. If we can just rock with me for another 20 minutes, let us talk about a couple of charts. That would be nice. Right. So I will be looking at phase 2. Right. So remember, in our challenge, these are the trades I've set up. This is called phase 1. These are the first setups that we've looked into. I'm about to build tonight and again tomorrow by myself. I'm going to upload first thing in the morning more signal trades, more setups, and I'm going to put them in this document, my rationale, entry points, stop loss, take profits, the old school way of doing it. You have no idea how much time it takes to produce such a plan. But if you don't do this, you can never assess. There it is there. There's a fib. See there? This is probably USD CAD. This USD CAD is USD CAD. I know this stuff by heart. You can see there, I've got an ante. Can you see my ante that I drew for everyone on the document? See there? The yellow line, swing high, swing low. And that's a golden ratio area. Be careful of these things, guys. Right. And remember, if you want to get access to this amazing, brilliant document and all the other trading plans I'll be doing, you just need to access the entire remote course, which is 67% off. Crazy. Right. So I'm hoping for now we can leave this stuff here because I really want to rock with the people who are just here for the war rooms. There is a disequilibrium with the number of people watching and the likes on the video. So please, if I performed enough so far for you and you like the video, please don't forget to smash that like. But let's rock and roll for now. So guys, those of you attending the live classes tomorrow, our private live classes, please note we will touch up on the Fibonacci. We'll go back into it. You'll see me use it again right now. But it's just time for me to kind of like, combine some stuff. Right, so I've already got specific trades to look into for the war room. Because remember, everything of mine is planned in terms of what I want to buy. But I don't want to, before we do that, I need to break down a couple of things. A couple of things that I'm watching for the month of for November. For the month of November, I will be tracking a series of very important, what just happened to my Zoom? Am I live? Okay, something weird has happened on my technical side. Just give me 2 seconds just to bring all my screens. Okay, cool. I'm still live. Right. So a couple of things have happened that I kind of like need you to know about. Right. In fact, a lot of it. Number one, I've been tracking 9 assets. I mean, obviously in the war room, I'm going to have something like 30, 40 trading assets to trade. All those are streams of income. Use smart risk management, right? The goal isn't to get every single trade right. The goal is to get 70 to 80% of them right with good risk reward ratio. So some of you can start to experience account growth. That's number one. Number two, when I narrow it down now for my intraday trade setups, I need to quickly update you on a couple of things. Number one, I've been tracking order flows, right? So a lot of our strategy relies on institutions, the banks, right? So I will look at COT reports and all sorts of things, but look at supply and demand fundamentally and come up with the math. So I just want you to write this stuff down somewhere in your trading plan because there's not enough time for me to break it down on this particular video, but I can make another one during the week. Gold, longs are increasing on gold and they are not really focusing on shorts, which is very weird. It's very weird because, and I want you to know this, there's a correlation Whenever we see weakness in euro, we must see correlating weakness in gold. When euro is weak, dollar is strong. When dollar is strong, gold is weak. Write that down. Say it to yourself a couple of times during this week. You will never forget it. Whenever we see weakness in euro, generally speaking, weakness in gold follows, because the only reason why euro is weak is because dollar is strong. When dollar is strong, gold is weak. We can't have two big safe havens competing, and in the background still have JPY and Swiss franc as a safe haven, right? So gold and dollar have inverse correlation. So right now, they keep adding bits by bits to gold longs, but as I do this, it's actually prudent for me to show you the charts. This is a brief chart. Remember, now I'm switching gears to war room, and if you get tired, I know some people say my stuff is too long. I understand, but who else is going to take the time to teach you like this? It's just gift and a curse, right? But if you get tired, you can always, you know, come back and catch up later. But I wanna reward the people that are there, and I want to give them, you know, a full show. But in terms of Fibonacci and class and all that kind of good stuff, I'm done. Right, let's go to the gold governing time frame so you guys can see for yourselves. Man, can I get another gold chart? So I just don't want to remove my lines and zones, right? So there we go. I've got my demand marked up, right? There's a governing demand. And I've just told you that longs are increasing. So it makes sense why longs are increasing. In a weird way, it doesn't. It makes sense because price is still at a demand. And if you go with my little trick to see the strength of order flows, order blocks, this is crazy, right? Halfway through the demand, price is still, so there's still a strong demand in gold. There's fundamentally still a very strong demand in gold. It's there, it's right there. So be careful of that, right? But I'm gonna give you the signals. Now, this could change. And remember, I keep telling you guys, if gold drops to 1.5, please, whether you're part of the Wealthy in 3 Years program, a separate program that I run from the remote course, which is a must-have in your life if you want to learn how to grow wealth, right? If you don't give me money, we don't invest your money, we don't want to be associated with individuals. They are so difficult to manage. We only trade for corporates, but empower yourself to know how to do this stuff. Make sure you buy gold EFTs. Obviously, I'll be watching this. So if gold drops between February, March, April, May, June, the first 2 financial quarters next year, which is in line with dollar strength. If we taper on the guys, markets are like a coordinated orchestra. You know what I mean? And the Feds are the guy who's just controlling the choir. If dollar is strong, which it should, because the Fed wants to taper, and he also wants to increase interest rates next year, which is already said on record. So we know you're coming up with a strong dollar. So eventually, we know that gold has to drop. Gold should drop because we now have a Bitcoin futures. We also know Bitcoin is a massive inflation hedge. It's the chosen asset. It's the people's asset, right? So be very careful, because its correlations allow you to eat your cake on all angles, okay? Good dollar trades, good gold sells, good. You just need to kind of like get into the rhythm of things. So just keep track of these war rooms. And if you're in class, which is a far much more better resource for you, keep watching those videos, all right? And I will be updating the remote course, so come back to them this December. It'll be a different course. Come back, module 3, come back to that stuff, because you're going to need it. Now, if you see this weakness next year, you're going to see a lot of gold weakness next year as dollar starts to gain strength. Get ready to invest in gold shares, EFTs, buy company shares, mining shares, buy, because this can't stay down forever. Ladies and gentlemen, this is a buy profile asset. From the beginning of time, all gold does is create major turning point highs and goes up. In terms of gold tech gurus, we've got a lot of gold hedge. Remember, there are some people who are just trading, market speculators, large speculators, the banks, etc., but there are other hedge companies trading because they own the asset. And the people who own the asset of gold, who own mines, the billionaires, are looking at a price target of 2.5 for gold. I'm telling you this right now in 2021. Next year when it happens and you're surprised, you'll be like, oh, no one told me. Yeah, I'm telling you now. When gold retraces, just look at your chart, man. Market structure will talk to you. When gold creates a downward spiral, what happens is it gets the zigzag vumbu vumbu, right? Which is something we use in this house for my 7-year-old to say price is about to go crazy bullish. So he always goes, my Bitcoin is going zigzag vumbu vumbu, right? Look at this. Boom, an explosion to the upside, right? Which always breaks market structure, BOS, a breaking of market structure. So we expect another downtrend. And when that downtrend comes to an end, can we clone this? Yes, we can. We can clone this. Let's clone it. Let's move to right click and clone. Right. When that downtrend comes to an end, this is an interesting potential. Now look at that. I just cloned it. I cloned it from this line of market structure that I just drew into this final demand inside of gold, where I have 1.5 and markets literally perfect cloning touch 2.5. It's not a magic trick. It's not a video game. It's the markets. So don't forget this. But anyways, longs are increasing in gold because, again, gold is currently inside a big demand and it's short-lived, I think, personally, because once again, if we see euro weakness, we're starting to see dollar strength, this should fall, right? So that's the gold chart. I'll come back to proper war rooms, right? Oil chart. We spoke about oil a lot of times. I'm so disappointed in myself with oil because I did finally get into the trade, but it wasn't the best entry. And a lot of it had to do with me forgetting, just simply not being disciplined to put the right pen in order. What am I doing? Crude oil. And every time I came back, it was too late. Markets had gone up, markets had gone down, etc. Right? So oil. Let's go to the daily chart. So we know oil is going up. I won't waste your time on oil. We removed the supply. If oil is going up, there we go. I bought in on the 7th of October. It's a good swing. I won't lie. I mean, I'm 6 days from holding this trade for 1 month, but this was a better entry right here. As soon as markets broke structure from that supply, when markets broke structure, remember, this is a supply that happened, then markets retraced for a very long time. Number one, this is a perfect buy, which was the first touch in this trend line, right? Long-term trend line. The first touch would have been nice. It would be nice to catch this. I didn't. I don't know. I kept telling people to buy oil and I forgot. I don't know if you guys got in. Right. The next one was this bullish engulfing pattern where price came back in and I missed it. But eventually I got the 365 candle, which is cool. And oil is going up. I expect a lot of retracement at 87 bucks only because Goldman Sachs has declared that oil should get there before the end of the year. So that's my price target. What happens is as soon as oil hits an institutional target, they remove their longs. We take profit, right? So my long is going to get closed. Same thing. When banks take profit, all the longs get closed naturally, instantly. As soon as it's like a seesaw, and it's always unbalanced and imbalanced. But as soon as the longs get taken out, all the shorts go. Right. So automatically, when banks take profit at $87 on crude oil, expect price to drop because there's no longer an institution pushing price up. They're taking profits. Markets might retrace somewhere here, stop somewhere there. You can draw Fibonacci, right, to see where it will stop. But expect that's what creates the swing high, the drop in price. As soon as they cool off their longs, price will drop. As soon as if market was going high, sell, and the sell takes profit, as soon as all the sell positions close, markets will automatically go up because the seesaw is now uneven. Am I coming across clear? I think I am. I hope I am. The guys watching this live, the time in South African time, it's 1952. If I don't know what your expectation is, I won't know how to pace myself. It's 1952. I know Jay is all the way in the Philippines. Are you guys okay for me to continue at least until 8:30? I mean, I can feel my voice is giving up, but there's so much I want to talk about. So I'm asking, can I go on for another 30 minutes? Can I get a temperature check on the live feed there? Can I get a yes or no? Are you guys able to hold on until 18:30? 2030. That would be about 9:30 in Kenya. Tanya in Dubai, if you're around, that's about 11:30 in Dubai. Jay, I have no idea, but probably like 2:30 a.m. in the Philippines, and everyone else in my time zone, that would be about 8:30 South African time. Just waiting for some type of confirmation because I just don't know what to touch on until I know how much time I have. Can I get another 30 minutes? Eunice in Kenya says yes. Bless you, Ma. Thank you so much. All right, Alvin in South Africa says yes. All right, so Mark, all right, cool. So Danny, thank you, Jay. All right, thank you, Mark. All right, so right now I'm getting a vibe that everyone is fine with this. So let me keep rocking. Right, so please note this. Oil shorts right now are extremely cooled off, right? So markets are just pushing forward. If you're a good outstanding trader and fundamentally know how to kind of like drill down your lower time frame, this is kind of like the stuff you want to look at. Right, this is the kind of stuff you want to look at. I'm on the 1 hour time frame. We already know this is a buy profile asset, right? Right. We know it's a buy profile asset. I just want to find the immediate areas value on the 1 hour time frame. Remember, I bought on the 7th of October, so there's no need for me to put my margin or equity at risk. I'm not going to be in the buy right now that I'm about to show you. But you can see on the 1 hour time frame that markets retrace several times a day, right, on oil, and then create a 365 traders. I hope you can identify all these demands that I'm drawing up, right? And markets create areas of value that they would like to return to. Why do I need to draw most of them? I need to find out the most immediate areas of value. I need to find out the most immediate areas of value. Sorry, I need to scroll back in time. Just want to see something. Might be easier with the H4. Too many candles on H1, it seems. This is even above the broken supply. So we're about to hit fresh areas of value, potentially fresh supplies. Where on earth are the candlesticks? Geez, I'm running out of patience. Right, so there we go. Hello, baby. Sorry about that, guys. I'm not so sure why she's outside the office. She talks now. Hey, my little girl, she hears my voice. She goes, Chris, she watches my videos. She just screams. I've got the biggest fan there. Feel blessed. Right, same thing with my older son, 7 years old. Right, okay, this is taking forever. I can't find it. So I'm just going to assume we're going to operate with the latest leg here. Right, so let's assume this is the latest leg, which it really kind of is. But just you, during your own time, make sure there are no traps on the far left. Right, but looking at the latest leg on the 1 hour supply, I'm going to go with the 25th of October. A supply was created. Right there. Right, and we can see prices dropping. Right, so demand supply on the H1 time frame. On the bigger time frames, we know markets are going up. So I'm saying if you wanted to find a high risk buy position, because this is really buying very close to where banks want to take profit. So this area is about to get extremely competitive. So before they reach their target profit, we've got about 60 days before the year ends. They might actually pull back price all the way down with your buy orders just to get a low buy to come up. So be very careful here, right? So naturally, the first thing that obviously comes out is a bullish engulfing pattern, which is right there, right? That's the kind of like the first thing that pops up. But the first thing that pops out sometimes is just Lucifer, man. It's just that attractive temptation, right? So I want to draw a couple of Fibonacci's to ascertain what's going on. So bullish Fibonacci, I'm going to be using anti-fib from this perspective. I have a nice swing low here. And obviously I've hit a 1 hour supply of a swing high. I've hit a 1 hour supply, but in terms of my daily, H4, weekly, monthly forecast, my journey has not come to an end. Because it hasn't come to an end, I am then moving with a retracement versus the reversal mindset. Right, then I'm going to apply a Fibonacci from the bottom of this area here to the top of that area there. That's Fib 1. I think that's as perfect as it's going to get. And I'm just going to delete my anti. I just use the anti to quickly keep showing you what's going on. Right, and there we go. So we have a situation here where this is a bullish confirmation that's sitting right between 50% and trying to make contact with that golden ratio. So this is a plausible area of value, all right? The area of value I am most likely interested in that with me, every time I find an area of value, I ask myself, what if I'm wrong? And that allows me to dig a little bit deeper. Inside the golden ratio, I get this. It's another beautiful a specific type of Fibonacci, but it's lower. And this is my golden ratio, right? You guys understand that. My golden ratio starts by the yellow line and then all the way down to the red line. And inside, in between the yellow line and the red line, I've got this bullish engulfing pattern. The first one could work. I ain't got no doubts about that. It's a very nice place. You can tell us that 50% mark. You can tell the stuff I told you about, support and resistance stuff. You can see markets bounce, 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 and then 10 support, 10 resistance, then bounce through, and then bounce again. Then there's a bullish engulfing just on top of it. So there's been some type of support there. Good for you. But anyone who takes this buy runs the risk. And again, Mr. Demlin, I mean, I might have to do a proper long-term class around liquidity rates, but essentially, banks could just come and go, yeah, this is nice, thanks, but we want to buy low and come here. Why? Because remember, discount, right? Remember the discount example I used. Would you want to buy something for 100% or something at 61.8%? I love Jaguars, my favorite. Actually, they called me the other day. They had a new thing. I'm not going to buy it because that's just crazy. I can't keep buying new cars, blah, blah, blah. But anyways, and they told me the price. This is the price. I love Jaguars. They know I love Jaguars. I take my car there for service. I test drive a lot of cars there. It's just fun. I love, love, love Jaguars. In PE, we don't have a Jaguar plant in Grahamstown, by the way, because it's a very small town. But it's a nice city, an hour, 30 minutes where I take my car for service. And if they called me tomorrow, they're like, look, Leroy, we showed you this car, and you didn't give us your usual answer. You were a bit hesitant. You're not interested. You said you want to buy some property this time around, and we understand, but it's a nice car, and we really think you could have it. And we know that the car is going for 1.4 M, but you know, because of who you are, Leroy, I'm nobody special. I'm just making an example. I'm nobody special. But because you're our favorite client, whatever they say, we're going to give you this car at 61.8%. Touch wood. Right now, I'm throwing my wife and my kids in the car and we're driving to PE to get it. You understand? That's what the Fibonacci is saying. It's saying, look, you could have bought oil at 85 bucks. Right, this is 84.59 US dollars, and you didn't, right? So we sold because it was a sell high. So I'm thank God you didn't buy when we were selling. But now, when oil gets to 82.52, you guys see this, right? 82.50 cents right here, 82.50 cents at this demand. This is a nice time to buy oil per barrel. We're going to be buying 1 barrel of oil at $82.50, and we're going to buy millions of them. That's how these guys trade or bank or think. They buy millions and millions of units at a cheaper price. I would take this 61.8%. 50% sounds nice. If they're like, look, man, the car was selling to you was 1.4 million rands, but we're going to sell it to you at 750,000, right? I'm like, yeah, now you're talking to me. And then the dealership next door goes, the exact same car, 0 mileage, completely brand new. We're going to sell it for you at 61.8%. My math is too tight to do the math, but let's say it works out to be about 600,000 rands. Obviously, I'm a logical human being. I get the same asset, but at a cheaper price. That's what the Fibonacci is saying. And I want you to know, smart money, banks, big institutions are obsessed with cheap things. They're obsessed with the correct buy low, and they're obsessed with setting it high. They will take the same asset that they bought at 61.8% in PE and bring it to Grahamstown to a down trader and sell it to that down trader at 100% value markup. They'll take the car for 600,000 rands and sell it to you for 1.4 million. And when you lose a trade in the market, 9 out of 10 times, that's exactly what's happened. You have bought an asset that the banks are selling, or you've sold an asset that the banks are buying. I hope I'm coming clearly across to you. So be very careful with this buy here. Risk very little. It is a bullish engulfing pattern, but no one say there's a 1 hour time frame, very small time frame. So let's start to move out. We've got 2 areas marked up. We've got this and this. Let's start to see what they look like on concrete time frames. Right, on H4, this is what we have. This is a situation on H4. We've got a bullish, bearish engulfing pattern reacting to a bearish engulfing pattern, which has already given us a fresh touch. A very big fresh touch. My goodness. And we should be scared because remember, our retests, generally speaking, not all the time, but most of the time, are much longer. A retest should normally outdo a fresh touch, normally. But this is a bullish asset, so we don't expect too much of a downside. Now, on the scale of things here, this is at 1 hour, 50% buy on the fib. This is a 61.8%. We've got what we call hidden demands. And I don't know when I'll teach on this stuff. These long wicks are hidden demands. But let's remove the noise. So we're going to go Hikini Hashi candles. I love what I do, man. Right? You see these Hikini Hashi candles. Hikini Hashi, by the way, you'd find mine is already marked up as favorites, but this is what I'm talking about. Hikini Hashi. They average everything out. They average buyers, average sellers, and they just tell you what was the dominating factor on that candlestick, whether it was the buyers or sellers. Now, for our trading strategy, if you've done our course, you'll know order blocks, order flows, order blocks, order flows. When you see them in a Hikini Hashi, they have more clarity because they've averaged everything out. So once again, no more candlesticks. Ugh, too many levels, too many order blocks. Is it this one? Is it this one? Is it that one? Is it that one? Is it that one? Is it that one? So many on H4. But now look when I switch now, but use both carefully. So now I know for a fact that this is my H1 demand, 50%, and this is my 0.618%. But my H1 demand has no confluence, right? It's literally at the top. It's at the area of competition for this Hikini Hashi. So technically speaking, for those of you who want to trade oil, if you want to have a very reasonable trade, which is why it's always dangerous to buy late or sell late. Look where I bought, where we all should have bought, because we spoke about this asset on a war room, right? I don't take trades anymore outside of war rooms. Sometimes I do, but most of them I give them to in war rooms, just depending on time. But now, if you're here trying to make a decision, this might have to be your entry point, that 50% level, because it's in line with the 365 candle. The problem is, for you to avoid loss, this is your stop loss. That's the problem. You have to swallow this entire area of value, right? And the 0.01, it might be nothing, it might be something, it might be depending on your account. Now, let's say you adopt my take profit. Let's say you adopt my take profit. You need a 1:3, because if you're wrong on this trade, you need to still survive the next day to trade again. You can't take profit at this supply, which, if I should remind you, has not yet been broken. This supply has not been broken. You're hoping they break the supply, and the furthest you can go before price turns against you is up here. Do you see the problem now? 1:1, so almost a 2:1. So some traders like these kind of trading setups where at least they're risking $1 to make $2. At 365, we understand it's okay, but there's a strong emphasis preference for 1:3. If I'm risking $1 of my money, I must make $3 back from the market per trade. That means on a cluster, when my strategy fails me, if I win 70% of my trades and lose 30%, because every single one of the 70% or 7 out of 10 trades that I win, I made $3 on the $1 I risked. When I lose $3, God, am I making sense? Am I making sense? Right, let's go to the whiteboard. I hope I'm making sense, man. I've got limited time. If you trade on a scale of cluster, let's say you trade on 10. 10 is a small sample, make it 15, 20, something like that. But 10 is also fine, but I find it small. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. What this means, guys, from a trading psychology perspective, you remove the technical analysis. The technical analysis is supply and demand. We know where price is going. From a trading psychology, the reason why you hesitate, the reason why you trade late, the reason why you use too many lot sizes, the reason why you enter a trade a little bit late, or you hesitate to pull the trigger, or you're afraid to lose money, all of these problems in your trading, if we're talking about pure trading psychology, it's because you think you know. Now, from a technical perspective, you must know when to enter, exit. And unfortunately, the way I teach supply and demand, I tell you that we know where price is going because we back tested it and we now know where price is going. From a trading psychology perspective, it is terrible. You're going to have to split. So when I teach module 1, module 2, I always tell people there is Leroy, the person. This Leroy is a cool, normal, boring guy. He likes to read books and trade and loves his family. Then there's the trader. The trader in me is cold, completely emotionless. I don't care about anything. When it's time for me to trade, my baby might fall. And if I know that there are adults in the house, it'll bother me. But if I'm focused, I'm focused. That's the cold trader in me. And I learned that from Until Krill because any type of emotion that flows between my pituitary gland starts to alter my perception. We project ourselves on price. Please, if you don't care about me, don't join my course. My trading psychology module will be for free on YouTube. You don't want to miss a single lecture on this stuff. There is nobody teaching this stuff anymore properly because they don't have the type of experience that they need to teach you. Someone will tell you, don't let your losers run and let your winners run. And they say that's trading psychology. What causes you to keep holding on to a losing trade? You are losing. You can see price is going against you. I mean, if you go through the screenshots where someone literally bought at a supply and our markets have dropped, and there's a buy limit order here, and they're still holding. And then they post it on those social media pages and so, guys, should I close the trade? What forces a trader to hold on? Fear of being freaking wrong. You don't want to be wrong. When a trade enters your pending order and you start to move your stop loss, you're changing your plan because you're waiting for price to turn. It's going to turn now. It's going to turn now. What about now? There's something wrong there, right? So this is literally what we need to talk to. Now, before I go too far, because I'm running out of time and I'm getting too passionate, I guess. Listen, trading in clusters. If I teach you my trading strategy and supply and demand, I don't care. If you follow my rules, and just my rules, and you don't follow trading signals and all the 55 Telegram groups that you're in and the 67 WhatsApp, if you follow my rules, you are guaranteed. And this is me being humble. I am not doing a good job of being humble, but you're looking at a 70 to 85% win rate. I take these trades too, so I know. You can't lie. In fact, our remote course and all our courses in the academy come with 100% guarantee. So if you join 365, you have 1 year to prove me wrong. 365 days to say, I followed your rules and my accounts keep blowing. And you just send me your broker statement. I see where you've entered and where my rules failed you. We'll sit down together, do a one-on-one and say, but here you did 1, 2, 3, but I taught you 1, 2, 3. You see why you lost? Nothing to do with my trading rules. This is you, Leroy. Leroy will get involved with the trader. The trader is automatic. Now, this is the best way to become more of a trader than the person that you are. Trade in clusters. I'm going to use an example of tens. Bearing in mind the oil trade we're talking about. If my system gives you about 70 to 80% win rate, or slightly more, but anyways, that means trade 1 might work, trade 2 might work, trade 3 might fail. For a trading psychology perspective, when I trade in clusters, I don't know, nor do I care which trade is going to give me money. I'll repeat this. From a trading perspective, from a trading psychology perspective, which is when you are trading in the zone, when you really get into becoming a professional trader. The difference between retail traders and professional traders is professional traders have no expected outcome of their trades. They simply mechanically, like a robot, trading the rules. Or there's a peak supply, sell, value-based demand, sell, PCP, clean imbalance, sell, Fibonacci confirmation on an order block, buy. We are just mechanical. Boom, 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 boom. And then after this is a win, this is a loss. This is a win, this is a win, this is a loss. This is a win, this is a win. You go, oh, okay, out of the 10 trades, all I did was follow my rules. And simple. None of these trades at the time of taking per cluster trade, per trade in a cluster, there is no hope emotion, psychological anticipation that this trade is going to work. Because of that, I leave my stop loss where it is. Because of that, I don't interrupt in my plan. I have to wait. I have to see if markets are going to go my way. It's as simple as all that. If you allow that to happen, what you'll start to see slowly but surely is your equity graph should look something like this. Yeah, there'll be bumps on the road. These are normal losses on any traders. And please don't be fooled. Wall Street traders take big losses every day. The difference is they're still multi-millionaires because they have a good equity graph going up. In forex, you can lose 70% of your trades, win 30% of your trades, and still be profitable. That is to say, you can still see your capital grow as long as your R&R, risk to reward ratio, accounts for this gap. Do you understand that? You can have more losing trades, but when you win and your R&R makes sense, every time I risk $1, if that's your R&R and I need to make 10, it's 1:10. Every time you lose 7 trades, you lose $7. But every time you win 3 trades, you win 3 trades times 10, you make $30. Do you understand? You're losing $7 per 7 trades, but making $30 for the only 3 trades you make. Your capital will grow. Non-brainer. Now, the oil trade that we've just set up here gives us a risk to reward ratio of 1.75. Now, if this is wrong and you make it a habit of taking such trades, your equity graph will look more like this. It's going to get very difficult to get back to your capital where you started. So that's why I'm saying if you want to take that trade, take it, but be very careful about it, because once again, the true buy is gone. Right, you actually want to pray for a massive retracement. Right, you really want to pay for a very strong retracement, and let me show you what you want to see. So those of you want to put patient pending orders and are just going to wait. Those of you take the H1, buys, it's up to you. But you can see where I bought here on that October buy. Let's go back to normal candles. I should be sharing the charts. I should be sharing screen 3 in front of you. You should be seeing the screen. I am aware of the time. I've got 15 minutes left. It is 8:15. Thank you so much for rocking with me. Those of you who are still around, I appreciate you. Etc. Right. So you see here, right here, price also created a bearish engulfing pattern. The bearish engulfing pattern failed because we're going up. Buy profile asset. Markets are going from demand to supply, all that good stuff. So because that particular asset failed to sell, this thing broken up. Now markets hit here, 365 candle, and went up and left some order blocks along the way. Once again, if we go back to our Kini-Hashi candlesticks, we can see that there was a hidden demand here. So for those of you who are super patient like me, right? I don't know. I will close my buy trade only if it breaks here, this white line. So if I see a break of market structure here, I'll know that markets are coming down for a deeper supply. I'll close this buy and come wait down there. Now let's look at this carefully. If you take this buy here on the daily time frame, and I'm sure we can get entries, far much more better entries on H4, you can see for yourself that your first trade was going to give you 1:7, right? So less than 1:1 risk reward ratio. But if you were to just wait a minute, right? So let's put the stop loss just below here. I hope I'm not confusing anyone. I'm just going to delete a couple of zones, right? So I'm saying if you were to take the next buy here, so your stop loss would be somewhere there. And let's say you take it from the daily demand, which is unnecessary, but let's say you do, which is somewhere here. Almost the same thing, right? It's kind of better. 1:758, but nowhere close to a trade or take home. So let's go to H4 and find a better entry. We now have a very good demand on at least on a good structure. This is the first time there's a demand here. So now all we want to do is to fix the risk reward ratio. So we're going to go to the H4 time frame, and unfortunately, I refuse to go any lower than the H4 time frame. Right, and then we get a series of complicated 365 candles, which actually create a nice, beautiful value-based demand. If you really look at it carefully, we've got dumb traders, got a short base and a strong rally. So then we adjust our area of value. I would cover this doji candle here, even though that's the reasonable body. I would cover that doji candle, right? And all of a sudden, we get a little bit. We get a little bit of room. We get a little bit of room. You see what I've done? Now your risk reward ratio is almost 1:4. So for every $1 you risk on the oil trade, if you wait, if you're patient and you buy down there, you get 1:4. And by then, we don't know what price would have done. Markets might have removed the supply, which means there won't be a supply in the way, which means that particular trade can run peacefully. But most of you don't want these trades because these trades are like my current Euro USD trade. It's a trade in the future. You want to make money tomorrow now, so you're just going to buy it, but set up. You gotta wait for the perfect setup. You have to always wait. Look at this. When markets do this, markets come back and move up. When markets do this, markets come back to it and move up. So markets have done it again. Now we need to wait for some type of comeback here. But this would be a better place to buy oil. There's a gamble up there, sure, but this will be a far much more better place to buy oil. My personal opinion. This is what it looks like on the H4 time frame. It's like you have everything. You have everything that you could have ever wanted in a perfect buy setup, as long as oil is still bullish by the time it gets down there, right? So if oil makes contact up here, right, it's an interesting ballgame, because at 87 US dollars, we need to make sure that there isn't a governing supply blocking your blessing. Look at this. Look at this oil chart. What's this? Delete these, go away. So many lines now, comrades, so many lines. Can I quickly go back to the H4 time frame and delete some stuff? Because now I can't even make sense of what's going on. I'm so sorry, guys. Guys, I promised to upload a very detailed war room tomorrow morning, right? I really hope this has been, of use to you. All right, so I'm gonna leave this as a blue line. 87 US dollars is currently a profit target. I'm gonna leave this blue. I'm really sorry. I know time has been slipping away. I thought I was going to give out a lot of trades and the teaching took over, right? And I hope it was of use to you. Even if you've done the course before, I hope you don't feel like I wasted your time. I hope you don't feel like I wasted your time. If I did, I am terribly sorry. But stuff had to be explained. So I'm just going to remove all these white lines because I want to see what it looks like on the governing time frame, because too many white lines are just confusing, right? So this is the buy. So we're going to make these white lines red. This is where we want to enter the next time oil comes back, and we want to see where the governing supply is, because remember, you don't want to buy when your governing supply has been triggered, right? So then I'm going to go to the governing chart. Okay, 87 US dollars is not by a governing supply. This is good news, because if price comes to that, now there's so many red lines. Oh my goodness, it's probably this one. It's probably this one. When price comes back to these lines that I'm gonna make white again, right? Where we want to buy, 87 US dollars might be where Goldman Sachs wants to take profit, but oil is going back to 100 US dollars per barrel, which means if you're disciplined and patient, right? This is 100 US dollars per barrel. You stand in the way of making this, and this is not an easy trade. There's going to be so many ups and downs, bumpy roads, and and you might have to hold it all the way into January next year. But it is there. It is very possible and up for the grab, because it's the first time markets will finally make contact with the real supply. Markets just broke a supply and it pushed price back to demand. Markets created a new demand down here. Can you guys see this on the governing chart? You guys see that after oil broke the supply, it made a new governing demand. Now, if you, oh goodness gracious, just delete all these lines. This, Father God, help me. Now, if you think about my multiple time frame analysis course on the remote course, week 1, module 1, week 4 or 5, somewhere in there where I teach about multiple time frame analysis. If you're looking at the governing chart for oil right now, and you simply, all you do is simply draw governing perspective, something like that, right? So this will cover the reasonable body. Some people want to cover the reasonable body of the engulfing period. It really makes no difference to me. If you draw, whether it's like this or like that, are you aware, if I make this red right now, are you aware when we get down to the H4 time frame, when we get this, there's confluence. There's literally confluence. And if not confluence, we can say it's close by. Right, it's literally one of the few demands just above your governing demand. But if you cover this body here, there is so much confluence straight to the H4 time. See, this whole red is from the governing time frame. Look at this. This is a strong area to buy. and hold. And it's a governing thing. And we want for price to come back into this H4 area, which has confluence with the governing demand. This is a good place to wait for a swing trade oil. Now, this trade is going to happen in December or November. I don't know. I don't know when. I never know when, and I never care about knowing when. I just need to make sure that as a trader, I'm mechanical. If it meets my rules, I put a pending order. It's part of my clusters that I'm going to analyze when I get triggered, and I make the money. It's simple. You want to time this trade. You want to sit and wait for price and wait for a pin bar and a confirmation candlestick and this chart and then enter. And by the time you enter, all the trading fears in the future are gonna trade against you. Price came too violent. Is it gonna really buy up, etc.? I'm gonna set a pinning order tonight on oil right there. And when it happens, it happens. But from a governing perspective, this would open the gateway for me to move from this governing demand. I'm not saying I'll be able to hold it for that long, or I'll choose to hold it for that long, but the option definitely is this, to hold it for that long all the way into that area of value there. Right, so I thought I was dragging the risk to reward ratio, but I was just dragging the H4 zone. Right, guys, I hope that makes sense. I've got 6 minutes left, so I'm just going to talk to you. No point in me running through another chart because of time, right? So I'm going to run charts, but I'm going to tell you what I've seen from the CFT reports, tracking order flows, looking at a lot of data sets. So oil shorts are extremely cooled off, so expect a lot of upward movement. If the shorts ran up enough to pull price back into this downward area here, be very prepared to take the trade. I'll even take the trade on the daily entry. Personally, right? I'm not going to buy anything with you here, but I'm definitely willing to buy oil somewhere down there if oil does decide to come back up. First TP is definitely $87 US. Second trade, break even and let it run for the next 2 months, 3 months. It will build your equity. Just think about that. Right, DXY, very important. Longs are aggressive on all fronts. Quick question, say, what about the increase in oil by China to the international market? When it will cause price to plummet just a little bit, and that might be what we need for price to come to that demand. But the increase in oil by China, because China is not really part of, is China part of OPEC? I wouldn't even know. I didn't even know about the point you just brought up now. Is China part of OPEC? If China is not part of OPEC, it won't matter, because all Saudi Arabia needs to do, and Russia and all those other weird countries, is just to reduce their supply, and things just balance out. It's that simple. Right, let's see. Right, Iraq, Kuwait, Saudi Arabia, Venezuela, blah, 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 blah. They're the founding members. And then later on, it was joined by Indonesia, Libya, United Emirates, Algeria, Nigeria, Ecuador, Gabon, Angola, and Guinea and Congo. And then they suspended someone in 1992. I don't know why it was so far off. Why can't you just tell me who is in OPEC right now in 2021? Right, that means currently the organization is 13 member countries, right? So I don't see China in here. So China can do what they want. You know, they can do what they want. It might create a little bit of retracement in the markets, retracement, not reversals, retracement. And then we might actually get to see some nice interest. Now, I'm so glad with the few minutes that I have, I can look at the DXY chart with you. Because colleagues, this is where trading separates babies from consistent profitable traders. On EURUSD, on the daily time frame, if you remember, and I know you do because you're very smart, on the daily time frame on EURUSD, the whole evening we've been talking about a bearish engulfing pattern. On the dollar index, we have a bullish engulfing pattern. Engulfing patterns need to be retested. Look at the alignment. They don't believe me. They think I've been making this stuff up. Let's pull up EURUSD on the other side of the screen. Don't worry, I got a pro account. I can do cool stuff and show you cool stuff with it. Look at this. This is EURUSD daily. This is DXY daily. I have a bullish engulfing and a red candle about to test it. I have a bearish engulfing and a green candle about to test it. I don't know, man. There it is. So, and I want to tell you right now, from the data I've gathered, DXY longs are aggressive. and shorts are cooled off, which hints more upside. In 3 days from now, FOMC is coming up. So you could get a very long, you know what, you know what could happen to shake retail traders off, to shake as many people off. This could go a little bit deeper. So a little bit of dollar weakness, a little bit deeper. And then this could go a little bit deeper after, upwards, find the best, highest type of supply, right, inside this whole zone here. And then, or even better, imagine this. Imagine how crazy this would be. Go back and retest this engulfing pattern. Because remember, when, not engulf, the 365 order block. Because remember, what markets did was take competition. Markets kissed strong competition here. But when we draw areas of value, we need the reasonable body. Come on, guys, don't act like I didn't teach you this stuff. So imagine this whole week markets go up, and everybody thinks, oh my goodness, Euro bulls are back, and then out of nowhere, boom, they sell through. Right? It's an unlikely scenario, but it's plausible. The order block is intact to handle that. The order block, the correct drawing of the order block allows that to happen. Or FOMC on the 4th of November goes, it's the 3rd of November. I keep saying 4th. It is the 3rd of November. I've been saying 4th for weeks, no one corrected me. Until at my staff meeting today. Oh, actually, no one corrected anyone. We just had a debate about it. Here's the 3rd of November, FOMC statement. There it is. It's the 3rd, not the 4th. I'm right. Oh, I was wrong, but now I'm right. It's 8:30, guys. There's so much to talk about. Okay, I'm going to cover this in tomorrow's video. You need to watch it. This Wednesday is ADP. FOMC votes to taper or not taper. On Friday, NFP. Retail traders are screwed. You will never survive the death. In fact, I put it in here. If you check my trading plan for the 16,000 US dollar challenge, you'll see I wrote it as clean as day inside this document. Please treat my trading plan seriously. I saw this a week ago. So I told you about the DXY. I told you everything that they're planning. 16 June, not a single demand has been broken on this chart, on that dollar index. And the dollar was coming from a governing demand. And I was a dollar bear for the longest of times, taking short swings, 3, 5, 7 day swings, selling. But the entire time we were watching the creation of the Biden demand. In fact, if you think about it, most Democratic presidents, Biden, Obama, who else before the Clintons, all presidential Democrats start off at demands, and Republicans will start off at supplies. I've told you this, Trump was a supply. Anyways, then I say this, the next 7 days are so important. So on Thursday, last week we had the advanced GDP, which was a fail, so dollar fell, which made, on Thursday last week, this was negative for the dollar. You see this there, advanced GDP. You think I'm making this stuff up? Because I'm not showing you, I'm talking from my head. You think I'm lying to you, né? You think I'm lying to you. So let's go to last week, Thursday, the 28th. There it is there. Advanced GDP was a fail, So what happened? The dollar weakened. On Thursday, who got triggered into Euro USD? This guy. Why? When the dollar weakened, all of a sudden on Euro USD on Thursday, you see this there? You see my arrow on the 28th, there was a strong green candle. Why? Because when dollar goes weak, Euro goes strong. So it shot up. So whoever assumed Euro bulls was wrong because they don't understand supply and demand. Dollar had to be weak to trigger Euro weakness and dollar strength to continue. And they are using news events to do that because news events serve as a catalyst that bring a lot of liquidity into the market. There's no time for this, man. There's no time for this. I'll start my video tomorrow around this stuff. Just be mindful. Where's the document? Where's the document? I walk you through the stuff. Right. Then I said on Friday, be careful. There's a price index month to month, which has already happened on Friday. Right. So the next day on Friday, we had month to month USD core price index. Look at this. They did nothing. No movement. Because Euro USD was selling like crazy. You guys think markets are random. That's your problem. Because that's what someone who's taught you, right? So you look at this. They literally zero data. The forecast is 0.2% because their sell orders are engaged on Euro USD and markets, the dollar stays at a low point for some upward movement. You guys walking with me? This document, I sent it up a couple of days back before all of this happened. That's why I said in the next 6-7 days, watch out for this. Monday, today was ICM manufacturing PMI data, and today dollar is falling. We come to the DXY chart. This is today. Look at this. Dollar is falling today. Why is dollar falling today? It needs to retest my bullish engulfing pattern. If you've done the course, I think the stuff actually sits much more clearer. I mean, I don't know for people who are new to my teaching style, but if you've done my course, I'm really hoping you see it, right? And dollar, look, oh my God, dollar is falling today, but look at this. It went better than expected. ISEM manufacturing PMI data. Look at Forex Factory. Don't believe Leroy. Forex Factory. Actually greater than the forecast is good for the currency. The actual was greater than the forecast. We had 6,4, 60,4. We got 60,8 at 4 p.m. today, 5 p.m. Kenya, 4 p.m. South African time. Why on earth is dollar falling if, according to your news catalyst, actual greater is good for the currency? The currency is the dollar. It's a US dollar news. It's falling. Watch how this candlestick will look tomorrow and how markets will close today and where price will be by Wednesday. All right, so I kind of like map all this stuff out to ADP, which is the precursor of NFP. Last month, ADP was, I can't remember now, but it was inverse. ADP was negative and NFP was positive, or ADP was positive and NFP was negative. It danced, markets are going to dance. This is a tough week for traders, don't know what they're doing. A very tough week because markets are using all of this to mean. I've just shown you 3 manipulations already. ADP, and then we've got another PMI, and then we've got the FOMC statement on the 3rd of November where tapering will come out or not. And then imagine announcing taper and NFP being a flop, or announcing taper, which is bullish for the dollar, and NFP being finally positive after 2 flops. That's going to be a mad dollar run this week. Be very careful. You are safer not trading this week if you're not sure. If you're sure about yourself, volatility is coming to us. And the best way to catch it is to set your pending orders and your traps and to see where your trades fall. Guys, my name is Leroy James, my series. Thank you so much for joining me. I know it's 2035. We did 2 hours, 30 minutes. There was so much to talk about. Can I just run down my notes? I just got a couple of notes to do, just to give you, you'll see them. They're just short, so that tomorrow when I do the war room, we are all on the same page, right? Do you guys see my notes? Yes or no? No. Right. So there are my notes here. There we go. Right. So gold longs increasing. Like I said, I've told you about the euro. DXY longs are aggressive, shorts are cooled off. We see more upside, which means you should technically be starting to feel bearish around Euro USD, Pound USD, if FOMC doesn't stuff things up. AUD longs are very cooled off. Be very careful. AUD USD, you'll see that price is falling, but there is an upside momentum, right? So the pressure, the upside we're seeing was built up because they closed their short positions. AUD USD is not going up because smart money is buying into it or putting more money into AUD USD. AUD USD is going up only because they've killed all sell orders, because the assumption is dollar is about to be strong. Do you want to be an AUD USD long when dollar is about to be strong? Absolutely not. So that could turn very quickly, right? But if we go to the chart 17th of August, and I will start with this tomorrow in the war room tomorrow, right? USD longs have been reduced, shorts are slowly increasing. So what's coming, you'll see on the chart there prepared for you. I'll do stuff. I'll show you all these charts in the war room take tomorrow. USD, this is going to be a crazy trade because it's got zero clarity. It's literally, can I just show you this one trade? Just this one trade. I know you have to go. Please don't feel like I'm holding you hostage. If you have to go, I understand. But can I just show you this? This is crazy. This was funny. We're talking about this earlier on today. So let's just go back to one view. Right. This is USD Swiss franc. Markets are in a rush. Bearish engulfing pattern. Markets are falling on the other side of a trend line. When you look at the data, the longs, the shorts are so small. I've just switched screens. Oh man, this is just Swiss franc longs, non-commercial. You see this? This is very important. So I'll say that again. USD Swiss franc, the shorts are cooled off. Remember, if it's USD Swiss franc and it's short, you want to sell USD Swiss franc because you assume dollar is weak. But if you look at Swiss franc as an asset by itself, as a currency by itself, look at this. Look at the longs. Very few people institutionally have put their money to create Swiss franc strength. They all think the Swiss is weak. 20,000 sell positions against the Swiss franc versus 1,000 buy positions. So if you add USD on the other side, franc is weak, which means dollar must go up, USD must go up. So be very careful. I really think this is going to be a big buy. And this is one of those buys that I want to get into. I've got 2 zones marked up. I need to make up my mind tonight. I have to make up my mind tonight if I'm buying here. If you do buy here, on the daily time frame, just remember that you could get dinged out, right? Because this is an entire big zone, and this is the trap. Number one, it's on the downside. It's not attractive to buy here because where on earth are you going to take profits? But they will make a lot of money here. I want to let you know this is going to be a massive run because of how little sell positions there is to USD Swiss franc. 120 pips, guys. We've held areas of value this big before in the past. Small lots and hold. If you don't know what to do, small lots and hold. Number one. Number two, equal size lots and do something like this. So 1, 2. I know I'm giving out a signal. I said it's time to go. I know. But there are 2 areas of value here. You see this below demand there. One of these is gonna skyrocket. I mean, it'd be nice if price was to come down here or down there, right? And what you want is to also accept the fact that there's a supply here. This is nothing to worry about. I know it's a breach engulfing path. It's nothing to worry about. Right. What's going to be interesting with this chart is when markets figure out where they want to bounce off and cross this trend line, which I've drawn from the weekly time frame. Please note, heaven's gates are open and we fly. We fly. Yeah, there's a weekly supply. We'll dance with it. Well, I won't even lie. I'm not even gonna close. I'm gonna go through the emotions. I'm gonna dance with it. Why? Because there's nothing in the way. This is a very good long trade to get into, right? There is nothing. All these compression, all this stuff, burnt out compression, right? I'll be looking. It'd be a miracle for price to get up here without being stopped. It's like that USDJPY. So the same setup happened with USDJPY. I kept telling people about monetary policy divergence. You can't stop this trade. You can't stop it. It broke this supply, broke the supply, broke the supply, broke the supply, and now we're up there. And trust me again, if you check my notes, we're going higher, right? So I'm trying to wrap up, man. I don't know. I should have had a war room yesterday. By the way, I didn't have a war room yesterday because I was not there mentally. I wasn't sick. I wasn't traveling. I just want to be transparent with everyone. If I'm not psychological, I just didn't feel like it. At 4 p.m., I kept trying to force myself to do this stuff. And I just know that when I talk markets, I need to be in the best of moods to do so, to kind of like give you guys the best thing, right? Anyway, shorts are so cooled off, very small compared to the long, so be careful of that. Supply took out the demand on Euro USD. We've spoken about that. I showed you the demand. Price dropped lower and created a supply on the, and created a new weekly supply, and price is going down. So I'm bearish on Euro USD. I don't know why people are buying it. GBP USD is going to go in Euro direction. Slight interesting thing to pick up. Their short positions are slightly smaller than their long positions. So maybe next week they'll add more sell positions. We shall see. USDJPY message push upwards, big supply right at the top. Long positions are very aggressive. Short positions have cooled off. I'll show you in tomorrow's war room what all these things mean. Guys, I appreciate you. I am rushing because I don't want to take your time for granted. Shake my hand, man, if you made it to the end of this video. Thank you so much for watching. Thank you so much for rocking with 365. Please don't take this lightly. I am starting to take less and less live classes during the year. If you join the remote course, remember all live classes are for free the next time there's an intake, right? So if you're in the remote course already, our February live classes next year are completely for free for you because you got in now at $100 or $150. Live classes next year will be $300 US on the dot, and I'll probably do 3 or 4 throughout the whole year, like I did in 2021. I did 4 in 2021. So next year I might do 3 or 1 per financial quarter. It just depends on my time. So do not sleep on this offer, right? 365. I've answered the oil question by Edwin. No more live questions there. Thank you so much, everybody. Have a good night. Goodbye. I've thoroughly enjoyed tonight. I've thoroughly enjoyed spending time with you. It's been good. So there'll be 2 videos tomorrow. Bitcoin futures, like 16 minutes. I did it in the morning today. And then a war room video going through a lot of assets, right? Got a lot of these assets to kind of like mark up and figure out, right? Let's get this trading right. Let's get December, January money sorted. Yeah, 365, shake my hand. Goodbye. I'm done. I appreciate all of you. I appreciate all of you. If you haven't liked the video, but you enjoyed the content, please like the video. And everybody else, I'll see you tomorrow for class. Thank you, Mom Eunice. Cheers. Jay, cheers. Damlin, cheers. Alvin. Cheers, everybody. Right, quick. I'm going to kill the stream, guys. Thank you so much. I appreciate you. I appreciate you.